to hold. But for a long position, I would suggest 1045 as a strict stop loss. And if that is hit or breached, you're better off exiting this one.
And what's the take on a Colgate? Because, some of these FMCG names in general looking very weak. Do you have a general view as well on FMCG? Is it an avoid at this point? Is this an opportunity? Colgate and then thereafter FMCG, Kush.
So yes, I do have a broad view, but let's start with Colgate particularly. I had a positive view on Colgate some time ago, and that's been negated, especially after the move that it's made today. The stock is close to an 18-month low. If you see the medium-term structure, the last time around the stock was at these levels was close to December 2023. So any hope of recovery that was coming about has been negated, and you're seeing such pressure not only on Colgate but broadly on the sector as well. So yes, I think we've discussed a couple of times where the time is long gone of being long on a particular sector, or even short for that matter on a particular sector. It's about being very stock specific, but that applies even more so when it comes to the FMCG sector, where a lot of stocks are seeing a downtick. Here or there, you could have a Britannia, perhaps showing some glimmer of hope. But other than that, I think most of these stocks will come under a bit of a pressure. We need to be extremely stock specific when it comes to the FMCG space. There was a rally emerging, has given away in a lot of these names. So now you have to be a little cautious. I would be a little circumspect before initiating a long trade on some of these things.
Well, you have to be cautious, you have to be stock specific is the call on charts, and that's what we're going to try to dissect here over the next 10 minutes. We'll have Kaustubh Pavaskar joining us very, very shortly. But let me bring in our in-house expert on FMCG, Mahima, joining us this afternoon from the studio. Will we see a gradual recovery from FMCG companies is really the question, Mahima, which I'd like to pose to Kaustubh. But before we do that, give us the take with regard to a Tata Consumer first. What are the expectations like and what is the likely outcome looking like for this quarter?
By the way, just before we get to that also, Westlife numbers are out.
I'm just seeing that.
And Mahima, what do you make of the numbers? 6% uptick in revenue, but the operational metrics look weak.
Yes, they look weak. Net profit down quite significantly. And it's the same case with Sapphire Foods as well. Sapphire Foods has turned loss-making this time because cost of raw material, other expenses has gone up overall for Sapphire Foods. I think the same case has happened here as well. It was slightly expected from Sapphire Foods, but not from Westlife. So I think we'll see that reaction soon on the stock as well. Net profit down almost 62%. I'll have to see if there is an exceptional item there, but the numbers prima facie don't look very positive. But speaking about the FMCG space, before I go on to Tata Consumer, just a brief view of how FMCG as a sector is expected to perform this quarter. Revenue growth might be seen because of price hikes being taken, and value versus volume growth will still be divergent. In terms of gross margins and EBITDA margins, they remain under pressure because of inflation playing its part. Gradual recovery in rural demand has been seen in the past few quarters, and that will continue this quarter as well, but urban demand is expected to be tepid. In terms of companies that will outperform, there is double-digit revenue and PAT growth expected in something like Marico, Tata Consumer and Gillette. Margin expansion expected in something like ITC and Nestle, but overall companies that will underperform, where negative revenue and EBITDA growth is expected, that is Imami is one of the counters which was a surprising one, and significant margin contraction expected in something like Gillette, Marico as well as Godrej Consumer. So that's with regards to the FMCG space as a whole. But Tata Consumer, as I mentioned, there's going to be double-digit revenue as well as PAT growth, but margins are expected to take a significant hit, and this is because of tea inflation playing its role. The expectations are that revenue may see a growth of 11%, PAT growth of 23%, margins will come down to 13.4% versus that of 15.3%. Overall volume growth will be in mid-single digits, it's around 5 to 6 odd percent. Beverages, because of unseasonal monsoon, might see a tepid growth. Tea value growth will be seen rather than volume growth, and salt and value-added products is something that will augur growth for the counter. International business will see pressure because of pricing interventions that's been happening for Tata Consumers, and overall tea inflation will play its part, and plus growing competitive pressure from the unorganized space, especially in the tea coffee space, is something that will be a key monitorable to watch out for. So that's with regards to where the entire FMCG pack stands, and of course where Tata Consumer stands.
Well, thank you for that. Westlife, by the way, perked up in trade. Let's pull it up in terms of the stock. It was up 1% maybe just a few minutes ago, but yes, there you go. So you're seeing that large spike. I'd want to wait for it to settle because numbers clearly not looking, looking exciting of sorts. But let's bring in Kaustubh Pawaskar, lead analyst, ICICI Direct. Kaustubh, first onto the stock which has just declared numbers. Do you at all track Westlife, and do you have a view with regard to any of these names?
No, we don't have coverage on Westlife Foods, but QSR space, I think for past few quarters has been the growth has been quite muted, and I think it will take another quarter or two for QSR to come back on track, because still the urban consumption is under pressure, and I think that will put a toll on some of these QSR players, and also the competition which is there from the online or online players, digital platform players. So I think that will continue to put some pressure on the same-store sales of these companies.
Kaustubh, hi, Mahima also joining in. Just want to get a sense on your, view on the entire FMCG staple pack. TCPL will be the first one to post its earnings today. What do you think, is the growth looking like in terms of revenue demand? I think it's, while I was seeing the commentary from a lot of reports, the commentary remains the same. There's gradual rural recovery, but tepid urban demand. Is that something that you're also taking up?
Yeah, so we are also expecting around 11% kind of revenue growth. And if you further dissect that growth from the business perspective, I think the India beverage, which largely includes your tea, it is likely to grow by around 9 to 10%. Your ready to drink, I think that particular space might see some slowdown in this quarter because of the unseasonal rains, but barring that, that particular segment is doing good. Your food business will grow by around 12 to 14 business organic growth. We have Capital Foods and organic fruits which were recently acquired. I think those together might contribute around 250 crores kind of revenues this quarter. And your international business, I guess around 4 to 5% growth will be there. Branded business, I think that might see some low double-digit kind of growth. So overall, I think we expect around 10 to 11% growth for this quarter. In terms of margins, I think margins will be under pressure because raw tea prices, coffee prices continues to remain high, and that will continue to have impact on the margins for another quarter or two. So this quarter also we are expecting gross margins to be down by close to 300 bips and operating margins to be down by around 200 bips. So overall we are expecting EBITDA margins to be at around 13.1% and adjusted PAT to grow by around 7 to 8% for the quarter for this quarter.
Got it, Kaustubh. Kaustubh, where is the growth here? We're talking about this large addressable market that India is, and I'm taking maybe a couple of steps back. We're not seeing growth, and this is across companies within the consumption space. What is it that's going wrong? Are we pretty much fully maxed out in terms of reach and penetration? Is that the challenge? Is new product innovation in the listed space a challenge? Where is the challenge? What are you seeing?
I think urban consumption is under pressure. Rural is seeing a gradual recovery. So I think till the time urban consumption remains under pressure, I think the growth will be moderated for the FMCG sector, because prior to that urban was doing good, but rural was under pressure. Now rural is recovering, urban is under pressure. So till the time both these markets see consumer sentiments improving and demand coming back on track, I think the volume growth will remain muted. But there is a expectation that whatever government interventions have been done, and monsoons are quite favorable, inflation is going down. So I think we should start seeing pickup in demand from the second half of the year. But it is going to be a gradual. There are two things which has been seen in the market. One is the competition in certain categories, which is really hitting hard to some of the players, and large growth has been happening in the premium categories. So I think in highly competitive categories, I think growth will be very gradual. But premium categories, I think growth recovery would be much faster, where there are only few players. Category penetration is quite low. I think those categories might grow much faster compared to what the highly competitive categories.
Kaustubh, just want to get your sense on the price hikes that these FMCG companies have taken. Of course, they don't match the kind of inflation that is on the rise, but there are still price hikes that have been taken in the past few quarters and will be taken this quarter as well. But a lot of these raw material have, come off from its highs, be it cocoa, be it palm oil. Do you expect that the trend of price hikes might go down in the few odd quarters going forward, and then there will be margin expansion on cards? Because on the other side, there are managements coming out and saying that they'll prefer growth over margin expansion. That's something that HUL came out and said. What's your view with regards to that?
Yeah, so we should start seeing price cuts happening. We have already started seeing that in the edible oil, because since the government has reduced the input duty on palm and other edible oils, and even the edible oils globally have seen some bit of stabilization. Because of that, we have already seen cut in the branded edible oil space, and most of the players have done that. And I think it will start helping these companies to see volume recovery in edible oil spaces. Similarly, we should start seeing wherever the companies are taking price decreases, I think that should help them to claw back the volumes. I think volumes is something which most of the companies are currently focusing on. That if raw material prices stabilizes, I think volume growth recovery will be more focused on by the companies, and I think that will happen. But it will be gradual. And as I said, that we should look second half as a better. Second half of the year of the fiscal will give us a better picture, where we might see volume growth to be much better compared to first half. And I think there are a lot of triggers or drivers which are going to be there, which will help to drive this volume.
Your quick take on competition, Kaustubh, because this is just my analysis that a lot of unorganized players from the unlisted space as well are giving competition to these large FMCG companies, be it tea, coffee, ice cream, etc. Is that something that is also one of the reasons as to why the demand of these products is not picking up? And if this continues, do you think this could be one of the factors that could be a major headwind going forward for all of these companies?
Certainly. See, in some of the categories which are largely commodity linked categories, there is certain pricing premium which the branded and the unorganized players have. When this pricing premium goes up over your average mean, then we see this unorganized and regional players getting more preference in the inflationary environment. But once this pricing premium reduces, and it reduces to the average level, or it reduces beyond that because of the price cuts or favorable raw material scenario, the preference again goes back to the branded players. So I think if raw material prices continues to correct from current level, we see that pricing discretionary environment coming back on track. On the other hand, consumption sentiments improves because of various factors such as inflation has cooled off. You have government incentives which have come up. I think that will help to drive the category growth. And as I said that the categories where penetration is quite high, we might see growth to be gradually improving, or it will be a limited growth. But the category where the categories are quite new, or penetration is quite low, where more and more companies are expanding their spaces or penetrating deep into different markets, I think in those categories, growth will be much better compared to what in the highly competitive category is. So I think it depends on category to category. But as I said, that if the price deflationary environment comes into the market, I think that we might see the branded players start seeing recovery in the volumes.
All right, Kaustubh, top picks at this point, value versus growth, and what's the best way currently to play consumption?
I think it is always better to remain selective in the space, and I think give more preference to the companies having better growth and even the earning growth visibility is much better. So in that context, we continue to like companies like Tata Consumer Products or Marico, where the earning growth visibility is much better compared to what it is for large FMCG companies. In the large FMCG companies, we continue to like ITC mainly because of the fact of its discounted valuations. But in terms of growth, ITC might do much better compared to the other companies, considering its portfolio and its focus on expanding into the categories where they have large room to play.
All right, thank you so much, Kaustubh from Mahima and myself for joining us and giving our viewers that perspective. We'll let you go on that note. Neeraj, what's clearly the consensus seems to be that it has to be bottom up, even in consumption. That seems to be both the technical as well as Kaustubh's view.
And that seems to be the analyst view as well, right, across?
Yeah. Correct, absolutely. But what do you make of the macro? Because just consumption, the numbers are extremely tepid. So what should one make of it?
Hopefully they pick up, because there is all eyes on consumption, not just in India, but also in China, right? Because they are trying to boost GDP growth via consumption. So let's see if that works out. But for now, yep, certainly tepid. At least the QSR ones have been tepid. But Mahima, thanks so much for joining in for this conversation. Lovely having you. And we asked Kush about some of these stocks, so we'll not do that right now. What we'll do is take a break, come back and try and kickstart that segment with some special stories and the dealing room check.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है.
मैडम एक बार को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Thanks for staying with us. Welcome back. Thanks for staying with us here on India Market Close. I'm Harsh, with me, Tamanna as well as Neeraj this afternoon, and of course Somi joining in as well, because it's that time of the show where we get whatever he's been listening to from dealing rooms and what the chatter is like. Heard on the street. Somi, what are you hearing?
Well, firstly, it's on Religer Enterprises, where dealers are indicating that the RBI approval related to the lending business might come in anytime soon. In fact, dealers are saying as soon as the fund infusion happens of the warrants, the 25% comes in, they're expecting the RBI approval to come in. So keep an eye out for that counter, because that counter has been gaining in trade since the fund infusion announcement has come in. Second stock on the list is Tata Chemical, and dealers are indicating that large HNIs have started to accumulate this counter in trade. Now, the buzz on the street or the channel checks are indicating that there have been a price uptick when it comes to soda ash, and soda ash is one of the key segments for Tata Chemicals. So a price uptick could definitely benefit Tata Chemicals here. When it comes to SAIL and Dr. Reddy, dealers are indicating that there are sell flows on large HNI desk on anticipation of weak Q1 earnings. Dr. Reddy will be reporting its numbers today post-market, so keep an eye out for both these counters in trade.
Are you hearing anything at all on Paytm? If anything, the kind of response that came in the morning, some pick up now?
So for Paytm, the thing was, if you look at the 1 month share price move before the results were announced, it was up around 20-25%. So most of these positives were priced in for Paytm.
Something you've also reported on this segment.
And also there was a buzz of Paytm getting included in the MSCI index, and now dealers are indicating that that actually might not happen with Paytm, because the last 2-3 days share price move, it's not qualifying into getting included into the MSCI index, and that might not happen, and hence we had seen that sharp downtick in the opening trade today. And now we are seeing a pickup in the share price, but that is largely because the numbers were actually good compared to what the street was estimating.
What's the cutoff for MSCI?
Well, 28th of July is the last date. We do not know the exact date, that the MSCI does not disclose that, but yeah.
Okay, bonus content today from Samit Sarkar on Heard on the Street on stocks that have been moving. Thank you so much, Samit. Kush Bora continues with us, joined now by Samir Dalal, Natwar Lal and Sun Stockbrokers. Samir, hi, great to have you in as well. Since we're talking about some of these platform companies, let's get your take on Eternal, Paytm and the others that have been in focus.
Yeah, hi. Thank you for having me on the show. And, so you've put me right in the line of fire, but my view is a little negative when it comes to some of these platform-based companies. Not because we believe that the growth is not there, not that we believe that the operating leverage won't play out, but we believe that valuations are far higher than what is justifiable, right? Now, I'm just going to first, since you said, let's talk about Eternal first. You're trading at a 3 lakh crore market cap, and your profitability is about 25 crores. Now, I'm not denying the fact that the profitability can scale up quickly, and they could probably reach 1,000 crores in the next 2 years, or maybe even 2,000 crores in the next 2 years. But even at a 2,000 crore profit and a market cap of 3 lakh crores, you're trading at extremely expensive valuations. So for an investor to make money, at some point, people are going to look at valuation. And I don't see that as an something, if I have to put money at this price, that I would be able to generate decent returns. Simply put, after you reach a certain stage, growth can start slowing down. On a small base, you can show exceptional growth, but then on a larger base, it may not be that easy. And also, competition is not going to let you keep eating into their business, right? They're going to figure out ways to make sure that they remain relevant and they also are able to grow. So we believe the competition is going to remain intense. Profitability is not going to come as easily as everyone in the street is expecting. So I am a little negative from the view that I think it's a bit overvalued. Paytm, yes, good set of numbers. I'm not denying that. From they got 1,100 crores from their services business, that is your fee business, but they also have a huge amount of profitability coming from your funding business, which is buy now, pay later, and things like that. And, so if I were to value the company on the basis of that business and just keep the fee businesses as a component growing independently, I think trading at about 5.5 times book value is a bit expensive. It's going to, there are lots of companies which are doing similar business models, not exactly the payment gateway, but even banks are doing, the credit card, the collection and all of that. I think competition for them too is going to be intense. It's not going to be continually easy to keep just growing endlessly. So for me, I am someone who looks at valuation on a valuation basis. Very difficult to generate a buy on either of these two.
To generate a buy, I think you should not be apologetic about your hesitation. A lot of the street is feeling it as well, and you can see it in that stock price. Well, atak ke, Paytm is climbing up despite everything that's happened. What about an Infosys and a Dr. Reddy's? Some of those that are going to report, and we will hear from. Any views there, Samir?
Yeah, so on Infosys, for the entire IT sector, we've been quite negative. We've been saying for a while that, look, this is for the Indian IT companies, especially the larger ones, we are moving to a lower growth regime. So the growth is going to be between mid-single digit to max a low double-digit growth, right? So between 5 to 12% maybe the growth rate on the top line. Now from these levels to keep increasing EBITDA for them margins is not going to be easy because of course competition is there for one, and two, you got a lot of benefits from the declining rupee. You may not be able to get that, and all of those, given the fact that you're growing at 10% and no margin expansion, your profitability is going to grow at a very similar rate, maybe 11, 12%. Now, when we factor in 12% profitability growth over consecutive years, and you're trading at 24, 25 times forward, it's difficult for a re-rating to happen. If anything, at best, you could get maybe, what the growth rate is, that kind of return from IT companies, and Infosys is no different. So Infosys might be able to post a slightly better growth than what TCS actually did. But still, we believe that, the US market, which they cater to in a large way, is holding back on spends till they get some clarity. And that clarity may not emerge anytime soon because there's constant movements of parts in the US with Donald Trump being active. So it's not going to be easy to assume that everything is going to become hunky-dory. Valuations remain fair and rich. So we believe consolidation, either stock price correction or time-wise correction, is still due for the IT companies, no different for Infosys. So for the time being, we feel it need not be a sell, but it's definitely not a buy. When it comes to Dr. Reddy's, yes, results for this quarter may not be great, but we still believe the long term is still very good for the entire pharma space, for the simple reason that there are lots of drugs coming off patent, and even Dr. Reddy's has a lot of ANDAs filed in the US. And as these drugs get approvals to start marketing them, we will see a good jump in their revenue and profitability. Of course, one overhang remains. The fact that Donald Trump is talking about imposing some sort of tariffs on pharma, but it'll be a delayed one, like a year, 2 years time for companies to set up in the US. So for the time being, at least it may not have an immediate impact. And by then, maybe companies will figure out ways to ensure that they have certain productions for large drugs which go through the US system, and some of the smaller ones going through India. So I'm not expecting great numbers this quarter, but I think the long term is still good, and Dr. Reddy still remains one of the stocks that we could invest in.
So long term here is the key. Well, one stock which is having at least a bad day, and is there an opportunity there, is something that we'll go back and we'll ask Samir and Kush, of course, is Lodha. Now, the stock has dropped in trade today, but because of a block deal. So you should keep that in mind. 7% down on that clean out trade, which was being reported, and we told you about it this morning as well. What is the story about Anushi joining us? Lodha developers under pain because of the block deal, but much more anticipated from it, isn't it?
That's right. So today's reaction is majorly because of the block deal that we are looking at. In fact, it's a 1% of a equity change in hands which has taken place. So roughly, if you see, it's about 1% of shares that traded in the block. Now, if you see the total size of that, about 9.95 million shares or odd, so have traded in this block, which resulted in this downtick that we are seeing, about 7% down in trade. Now, the size expected reported is around the levels of $165 million as well. So it's a considerable big one that we are seeing now. Floor price was also already at a discount of 4% as what was the expectation that we were seeing. Now, this is not the only counter in which the block deal had taken place. Oberoi Realty was the other counter as well. We are seeing cuts over there as well, and the seller in both of these deals likely is Invesco Fund, is what we had reported earlier, and Goldman Sachs acted as a broker to these deals is what we are seeing. So some bit of impact is what we are seeing on that, and that has an overall effect on the Nifty Realty pack as well, because that is down under pressure. In terms of how Lodha Developers is doing, if we just take the current or the recent updates in picture, they came out with their Q1 FY26 business updates as well, wherein they reported a 10% of a growth in terms of where the pre-sales are concerned, while for collections they saw about a 7% growth. Now, just taking this in consideration, if we see the past quarter's pre-sales number and see the kind of growth picture that were there, 17% was the growth that we'd seen in the first quarter of FY24, 20% in FY25. So compared to these two fiscals, we did see that pre-sales for this particular quarter has narrowed down as compared to the others. In terms of the peers also, if we see the likes of DLF or even Prestige Estates, they came out with stronger updates, just achieving about 50% of the guidance in this year itself. So that's the kind of outlook that we are building on. In fact, if we see the company's outlook on the same, they remain on track to achieve the FY26 pre-sales guidance, which adds up to about 21,000 to 22,000 crore. They've also added 5 new projects with GDV value of 22,700 crore. Now, this is a key positive considering that they've already achieved their 90% of the GDV guidance that they had given of 25,000 crore. So this is a big positive that we are looking at in terms of project additions. Now, the company does expect the collections to be stronger in the second half of FY25. So a pickup is something that we should be watching out for as well. Now, as far as where the analyst coverage is concerned, it's a mixed picture that we are seeing about 13 buys, 4 hold and 1 sell rating, which brings up to an overall potential of around 7%. Now, that's the kind of picture that we are seeing for Lodha Developers.
Well, unfortunate moves today for Lodha. In fact, for the entire real estate pack, the top loser. But Anushi, thanks for putting that into perspective, and which is why it becomes this space to focus on. Now, Kush, maybe we spoke about it briefly, but a lot of viewers tuning in right now and would want to know what to do with real estate in general and Lodha in particular.
So, Neeraj, I think as far as real estate pack goes, we'll have to be yet again, we'll have to take a very selective approach here. As far as Lodha goes in particular, no, I don't think this is the end of it all. Medium-term support was around the 1530 mark. That's been taken out. We know by the volumes have spiked up. But I would want to see it, take support near the 1290, 1300 zone, which is the next level of major support zone. If that is held, then perhaps some sideways consolidation. Some uptake is likely, but very difficult to say that this will perhaps see a V-shaped kind of a recovery. So yeah, Lodha in particular, no. We have spoken a couple of times about Marathon, and while yes, Marathon has also seen some shave off, from the higher levels of 770. But mind you, this has come on the back of a very sharp up move where the stock went from 470 to about 770 levels. This drop also is not on the back of very heavy volume, so profit booking at best. If you want to consider some of these names right now, the likes of Oberoi Realty, even Brigade for that matter, are testing their support zones. In fact, the Nifty Realty index itself is testing that support zone of 960, 965. If that is broken, I think some more pressure could come in. So a little circumspect, but if I have to see for a shining light, then Marathon, despite the kind of taunting that it's seen in the last 3 to 4 sessions, gives you that opportunity to re-enter. But other than that, I'm not sure if we can see a V-shaped recovery. So be a little circumspect on the moves in the realty space.
Okay, Mass Financials numbers were out too just a minute ago. 27% uptick, I believe, in NII, if I'm not wrong, right?
Total income. No, that's total income. Yes, total that's income. Correct. NII, I think, is a more muted number. And I would suppose that would be the case because obviously rate cuts, the full impact is not yet fully translating on the expense side, and therefore that is understandable. But even when I'm looking at the overall profit after tax number, it's a healthy kind of a growth, around a 19% YOY growth on the PAT number. I'd be more curious to understand what the AUM growth number is, because this one is a consistent, strong growth company, and therefore We'll wait for that AUM number to actually come out, Neeraj, before we can fully determine. But of course, you can see the spike on the stock on your screen, around 1% up on a Mass Financial on the back of those numbers. Samir, any NBFCs on your radar at all, the smaller ones? And okay, let me try and club this. We had Credit Access come out with numbers. That stock is perked up 5% in trade. The numbers were not particularly enthusing, but the commentary was. So maybe if you can give us perspective on some NBFCs and within the MFI pack if you have a favorite.
We have a coverage on NBFCs, and we do think that there's a great opportunity for growth and stock appreciation as well. So, if you ask me, I think still the housing finance space, which is the secure lending space, is something that remains prime focus to me. That's something that we have always been saying for a while, that is a segment that can continue to do well. So in that space, the two companies that we kind of like and we've discussed in the past, one is LIC Housing Finance and the second is Sammaan Capital. Now for LIC Housing Finance, the big benefits that are going to happen is all the rate cuts that are going to come across because of the cutting of interest rates. So they are going to get their costs cut in early and they will pass on their rate cuts, meaning maybe like a couple months or a quarter down, right? So you're going to see a decent amount of NIM expansion. They've done a lot of the provisioning that needed to be done. Yes, growth has been in the recent past a bit of a challenge for them given the base has become quite large, but we believe they can continue to grow at about 10 to 15%. And given you can grow at 15% and you're trading at one-time book value, I think there is a re-rating possibility as well. So that is one of the counters we are quite positive on. When it comes to Sammaan, they're trading at half-time book value. We just discussed the kind of growth opportunities that are there. They've actually been on a much smaller base, been able to grow at a much quicker clip. On their new books, their old book is running down. So if you look at it, the new book, which is Prime Plus, is doing quite well. So we think that's a positive there. Now, when you come to the MFI space, well, unfortunately, for some reason, yes, the pain is continuing, but I think we're at the fag end of the pain, right? A lot of the pain has been taken care of and adjusted. So L&T Finance reported they have a good large exposure to MFI and they've done relatively okay in that space. Yes, we had Bandhan, which saw a little bit of negativity there, but we believe even Bandhan Bank is at the end of it. And, what you will see is the MFI business starting to see
one top pick.
So if you ask me a top pick in the large cap, I would stick with LIC Housing, and for the mid cap, I would go in with Sammaan Capital. Like I said, that is the space I'm very
LIC Sammaan. Kush, on the charts?
For me, it's slightly different. L&T Finance has been, a pick for some time. I would continue a call on L&T Finance 220, 230. These are the next levels to watch for on the upside. Support near 205, so good risk-reward ratio. But if you're looking at it from a slightly positional standpoint, then I think AB Capital is consolidating. After nearly doubling in 5 months, mild consolidation is quite healthy for AB Capital. This is preparing the stock for the next leg of up move to 285, 300 plus kind of levels, and supports near the 250 zone, very healthy. So momentum pick L&T Finance, and a positional pick AB Capital.
Okay. L&T Finance, AB Capital, but we should talk a bit about Dr. Reddy, something that Samir spoke about in great detail earlier as well. But what are we expecting from the numbers which will come in later today? Let me go across quickly to Varsha, breaking it down for us.
Thank you so much for that. So steady numbers are expected when it comes to Dr. Reddy's Q1 FY26. Just to speak on the 4 numbers, revenue is expected to rise 13%, while EBITDA is expected to rise 9.4%. Margins are expected at 26.8 versus 28% last year, and net profit is expected to rise 8.7% year on year. Now, growth will be led by strong performance in India, Russia, and rest of the world markets. But the disappointing factor over here is the US sales is expected to decline 11%. Now, this is on the back of cancer drug Revlimid price erosion that the company is seeing. and that's the reason US business may decline, and India is expected to see growth of almost 11%. Now this will be driven by good performance in the key therapies. Profit may be under pressure because of the increase in the R&D expenditure and of course some of the operational cost. Key factors that investors should watch out when it comes to Dr. Reddy's is update on the potential launches in US, which is expected in next 12 to 18 months, and also the status of the biosimilar pipeline that the company has been indicating us, and the last is to track effect of licenses and partnerships formed in the recent years. So overall steady numbers are expected, but yes, US revenue may decline on the back of Revlimid pricing erosion.
I think the question is that is this a buy candidate ahead of the numbers? With some of these larger companies right now and the way markets are going, you need to get ahead in the queue. Vishal Manchanda, let me put that question to you. He's Senior VP, Institutional Research at Systematics Shares and Stocks. What are you looking out for from a Dr. Reddy's?
So we have a different view on the numbers. Probably we are expecting a strong set of numbers on back of generic Revlimid showing better numbers than expected. So our view on generic Revlimid is a large part of generic Revlimid sales will get booked in Q1 and Q2 of this financial year. So like what we see in the past, what we have seen in the past is Revlimid sales getting staggered over 4 quarters. But now what we'll see, the full year sales of Revlimid will get booked in 2 or 3 quarters. So that will lead to higher sales in the US. And that's why we are expecting strong growth in the US for Reddy's. But we'll wait and see what happens there, because Revlimid remains a bit unpredictable on a quarter-over-quarter basis.
So if you're penciling in stronger results, do you think right now with the movement that we've seen in Dr. Reddy's, there's a positional trade here?
So fundamentally, our view on Dr. Reddy's is a hold rating on the stock. So basically, they've been highlighting certain growth opportunities in the US, where we think there are a lot of uncertainties, and we need to wait and watch how these pan out. And I don't think the risk reward is that great at this price. So that's why we have a hold rating here at this level.
Vishal, this is Harsh joining in. Vishal, give us the underlying for that. Your assumptions of front ending, is that largely tariff driven?
Sorry, I didn't get you.
Why do you suggest that Revlimid sales will be front ended this year? Is it tariff driven?
So what happens is, so one is tariff driven, that is true, and other is the Revlimid exclusivity expires in December. So we have 3 quarters, and then probably in the last quarter we'll see a lot of inventory destocking. So the channel getting cleared to kind of stock to be prepared for the generic entry where price erosion would be steeper. So people would stop buying generic Revlimid probably from the 2nd quarter of this financial year, and not the 3rd quarter. So that's why I think generic Revlimid will get kind of all of that will come in the first 2 quarters. The full year numbers will come in the first two quarters.
And Vishal, how are you seeing the India business do?
India, I think they've done a lot of in-licensing activities, in-licensing deals, the Sanofi vaccine portfolio, and some product level licensing also. So mid-teens, high-teens growth on the top line is something we expect. But the in-licensed portfolio will have lower margins than the base portfolio.
Okay, Vishal, just one last point, and I know we're talking about Dr. Reddy's, but in the broader space, what are you liking in the pharma space right now? We've already seen a lot of excitement on some players like Glenmark actually, because of innovation and some of those stories coming through. But what would be your top call right now in the pharma space?
So Sun and Cipla are the preferred names for us in the large cap category, and we have a buy on those 2 names.
Sun and Cipla is what you're sticking to. Thank you so much, Vishal Manchanda there. He's, of course, from Systematics and tracks the space very, very closely. He says it's a hold on Dr. Reddy's, and don't expect fireworks, maybe strong quarters because of how Revlimid is going to pair out on their balance sheet. On the charts, Kush, is there a positional play on Dr. Reddy's? Let's add Sun and Cipla since you mentioned those specifically.
No. Very, very delicately placed. I wouldn't trade Dr. Reddy's because the medium-term trend is negative and it's dearly taking support at the 200 moving average. Any negative surprises, and you could see a sharp downtick to 1210 levels. However, if it does rebound, then immediate resistance is at 1265. So no, technically very delicately placed. I wouldn't really trade Dr. Reddy's. Even Cipla, for that matter, has been slipping lower. Sun Pharma also trying to take support. So no momentum per se, and nothing to suggest that there could be this immediate uptick. If I just broaden the horizon a little, to the pharma space, Syngene has had a good run in the last 3 days. Volumes also picked up rather well. There's a gap near the 715, 720 mark that could also be filled in this momentum. So yes, I mean if you broaden the horizon just a little, then yes, with a stop loss near the 665 mark, Syngene has a very good setup over the last 3 sessions.
Okay. All right, we'll take a very short break. Markets are perking up. The second half of the trading day seems to be better. We're coming back with what your top picks should be and more on the other side. Meanwhile, Kush and Samir, thank you so much for joining on this leg of the show. We're coming back with more analysis very, very shortly. Stay tuned.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है.
मैडम एक बार खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
हेलो
हेलो
बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है?
मैडम एक बात, खौफ किस लिए रखना चाहिए? तो
Welcome back. Auto is buzzing this morning. Look at Maruti Suzuki, look at Bajaj Auto, look at Tata Motors. Tata Motors, your top gainer this afternoon in trade. You know, some amount of buzz there. You're also seeing your NBFCs showing some action. Shriram Finance, Bajaj Finance, all of them up in the green. Adani Enterprises having a good day. Bajaj Finserv also doing okay. I want to pull up Bajaj Housing Finance and see what's happening there, because you're going to expect numbers to come in at some point. So at least a good perk up on the Nifty. Can we pull up Nifty contributors very quickly and look at what's powering out there? I presume it will be apart from the banks, some of the auto stocks, and RIL has woken up. Let's see the intraday chart of Reliance Industries and look at what's happening there. After 2 days of getting beaten down, just about less than 1% up, but a heavyweight is a heavyweight for a reason. On the losing side, some of our consumption plays are really not looking exciting at all right now in trade. Now, meanwhile, some of the other movers this afternoon, I think, continue to be financials. I mean, the kind of push that we're seeing in ICICI Bank, third day in a row, ICICI Bank and HDFC Bank, that's something which is turning out to be quite exciting. You know, if you look at the move over the last 4 or 5 days and put that into perspective, you realize that there's a lot of strength over there. In fact, let me take that question to Ambrish Baleka, joining us now, independent market analyst. A very good afternoon, Ambrish. Great to have you. Let's start talking about the private banks and the continuation of that positive momentum there.
Right. I think private banks, I mean, earnings were fine. I mean, you look at ICICI, I mean, except for Axis, which was a bit of a disappointment. And going ahead, clearly we see the credit growth improving, and especially with the expectation of another 50 bips cut by December by RBI. I think I mean we should see the credit growth really improving if you're talking of towards the end of FY26, and that's what I think will drive these banks, especially the larger private sector banks and the larger PSU banks.
Okay, some numbers from Syngene, and they seem okay too. I mean, 10% for a CRO firm, 10% revenue growth, 14% profit growth, and it's okay. I mean, I personally don't think this has got the needle to move the stock, but it's an okay quarter. I think SRF numbers are out as well, and they are slightly below estimates if I'm not wrong. So that's the other set of numbers you got to keep in mind. But just remember, in SRF's case, the stock tends to make a move after the conference call, and therefore in the con call, which probably happen tomorrow, if they say something which is very dramatic, then the stock could have a meaningful move. So please be careful if you're trading SRF. But the Syngene numbers seem just about okay, so nothing too dramatic there. This whole space, Ambrish, CRO, CDMO, but we've spoken about CDMO enough. Let's talk about contract research firms, right? There is Syngene, there's a new one, Vida Healthcare, which is coming with their IPO, and a few others. Do you like this bucket, or is it too niche?
No, it is niche, and because of which it should get that higher multiple, no doubt. But clearly, I mean, we need to see as to how the earnings are for the companies, whether they are volatile or whether we are seeing a steady improvement. And I think that's what is to be seen as far as this space is concerned, because you need, consistency. I mean, that's what investors like. So unless you see consistency, it doesn't make sense really buying into these stocks.
Okay, you know, we're talking about auto today, and auto is definitely buzzing, and new launch there coming in from Renault. What's also striking is what the company is saying. They're saying they're not looking at any partnerships right now in India. This is coming from the managing director who spoke with us at the launch of their new car, Triber. Listen in.
We have the design studio, we have the engineering, we have the manufacturing, and we have the commercial with the 350 touch points. Do we need a partner? Is the first question which people have to answer.
And what will you answer to that?
I don't need.
You don't need a partner, so no more JV partners in India going forward?
Are we looking at it? No, we are not. At this point of time, we are going to be Renault in India. We have a Renault group in India. We have a CEO. So we are here to succeed and then perform. And with the first launch, and we have 3 more launches to go in next 2 years.
Right, so let's talk about performance for a second. Your share in the PV market has dropped to 0.93% in FY25 from 2.8% where it was in FY20. Now, a lot has changed since then. The Ukraine war has affected production. India's sales have gone down. But you plan on selling 500,000 units annually by 2030, which is more than 10 times what's currently happening. So, how do you bridge the gap between the vision of a 5% market share by 2030 and where you're currently at?
Okay. First of all, it's not 0.93, it's 0.98. So that's the current market share. As I said before, that after last 5 years, we did not do any launches because of the Renault Group constraint. Now we have taken a lot of steps globally, and we are here with the International Strategy Hub. One of them is in India. The investments have started flowing in. As I said, 4 products in next 2 years, and this will continue furthermore. It's not the end of the story. With the 5,400 crores which we have invested, we are going to get those 4 products into production and then sales. It doesn't stop there with the domestic market, but it will also goes into exports. So we have our plan to meet what is required and also to make sure that we capacitize the plant, which we are below 50% along with the alliance partner. And our first endeavor is to make sure that you fulfill your plant capacities. And that's the objective. And I'm sure, I'm very confident that with the new products, and which are very unique in nature, and that will take us to the level where we had been talking about.
So what's the update on the plant capacity? I mean, with the JV partner, it was below 50%. And right now, you are saying that we plan to go forward. But any update on how much, on what's left of the plant deal that's going on, and where will the capacity be within, say, 1 year?
I think you need to understand a little bit differently. Nissan will continue to be our contract manufacturer. So the partner is still there. It's not that they have gone out from us. So the capacity doesn't change whether we acquire 100% or we don't. And they continue to work with us, and we will also continue to work with them. And they also have their product launches, which they should be talking about. We have our product launches. So both together, we will make sure that plant utilization is taken care.
Well, that's on Renault. Let's talk Paytm now, because that's our bull versus bear stock for the day. Let's pull out the first bull case. Of course, it's an EBITDA beat, PAT beat. I wouldn't really bet my horses on that one. That's the easiest bull case I've had in a while. The bear case, well, PBT is negative. And if that is, of course, it's negative adjusted for other income. So the other income is what's driving the PBT and PAT number, which could well be a bit of a concern. Now, bull case number 2, expect a QOQ improvement in margin in each quarter all through FY26. That was what the guidance was. How much? Non-committal, but a QOQ improvement nonetheless. Now, other income was 241 crore. What you want to see is operating profit positive. So I want to start to look at when does operating income turn positive. Outside of other income, can we have profit after tax only on the operating front? So that's really the question, and that's my bear case. Third one, there's scope for further OPEX optimization, and that is likely to drive margins forward. Mind you, margin guidance is 15 to 20% in the medium term, and that's going to hold the key, frankly, with regard to the re-rating on the stock from here on, because we've seen a very good rally. But the bear case here is operational profitability is still awaited. We want to see that operating profit number come into positive. Maybe a repetitive point, but nonetheless, that is something where we are far away from. We need to wait for that to come. Now, the bull case, scope is there credit growth in personal loans is likely to have bottomed. Now we'll start to see credit growth pick up with regard to personal loans, and that is a big positive for Paytm. Could we see that pickup? Well, they were non-committal on the call. They said no visibility of the pickup yet, but yes, the likely bottom has arrived. Mind you, for Paytm, in terms of profitability, loan growth is the key metric to track because that yields the best profitability in terms of the product mix, and therefore you want to look out for when does credit growth pick up in personal loans. Now let's talk about the valuations. Currently trading at 96 times 1 year forwards as per Bloomberg estimates. Most market estimates are predicting the valuation at around 35 times FY28 EPS. So they're expecting a very strong tailwind in terms of profitability all the way through FY28. If you're looking at FY28, the 35 times multiple not looking as expensive. But at the same time, the average analyst estimates on Bloomberg see only a 2% upside. We have had a couple of upgrades and therefore looking interesting. We'll have to see maybe over the next couple of days what are the upgrades like. But largely, you're starting to see valuations looking full here.
I think you're far from the kind of valuations you're seeing on other platform companies. So maybe some room to grow there. Let's quickly get in Shivangi Sardar joining in and her view on this right now. Very good afternoon to you, Shivangi. Just let's start with your take on Paytm.
So we've seen that the indices have been, showing good signs of recovery from the last 3 trading sessions. Nifty put call ratio has improved along with the decline in the India VIX, which clearly indicates that bulls are in full comfort. Even at these levels, we're seeing that, the market has been witnessing a good run-up and the banking stocks have also kind of contributed to this entire run. Talking about Paytm, of course, we've seen that this stock has been, a performer lately. And talking about the levels per se, we've seen that on the monthly basis, it has been forming higher highs, higher lows from the last 4 months. And it has surpassed its previous hurdle zones of, 1,060 levels as well. Trading very comfortably above those levels. Of course, the volumes have also added in this accumulative zone, which confirms the up run. We are expecting a next, levels of around 1,100 for this one with a support of 1,050.
Okay. Just looking at Syrma, net profit in at 49.7 crores versus 19.3 crores. Revenues have come down though. You're seeing quite a bit of a zigzag there, small spike up and then the stock down again. EBITDA though is up nearly 91% at 86.6 crores versus 45 crores. Look at the margin jump. Wow. We'll get Puneet in just a bit to break this down for us and some of those details, but margins gone from 3.9%, 9.2% as well. So a big margin jump there on Syrma as well. A lot of numbers coming in at this point and we'll get them all together for you on how they're looking at. In fact, if you can just pull that up. Numbers which have come this afternoon, quick run through in case you missed it. PCBL, for example, weak numbers owing to lower product margins. Sapphire Foods, operationally in line. KFC same-store sales are flat year-on-year after 6 quarters of degrowth. Westlife, that's why I'm neutral there. Westlife Food is a thumbs down. EBITDA and margin expansion is limited mainly due to weak same-store sales growth performance. Sky Gold was a winner. EBITDA up 92%, margins expanded 110 basis points. Quite a few have come in. Syngene as well, I'll add to that list. Good numbers, EBITDA growth at 22%. SRF was a weak set, chemical segment especially. EBIT was down 35% quarter on quarter. Earnings stable for Mass Financials. You've given it a neutral, I believe.
Yeah, I mean, I'd want to wait, as I said, for the growth number. The positive is that provisions is absolutely flat on a sequential basis for a Mass Financial. Yes, please.
Yeah, now, just before we move ahead though, if we have Kush Bora, I want to understand if there is a trade on the Nifty, or rather Shivangi. I want to understand if she would go and buy the Nifty at this day's high, because at 0.7%, there is a conclusive upside or an uptick that we've seen in our markets today. So we'll get to the exclusive in a moment. But Shivangi, just trying to understand, would you buy or trade the index, either options or futures, at the current level? We are at the day's highs.
So, talking about Nifty, we've seen a good recovery, and of course, the derivative data points have also indicated that the bullish undertone is being respected. And we're heading towards the July expiry next week. So, of course, there will be a lot of volatility, which is expected. Swing trades in the option as well. But overall, historically, from the last 10 years, we've seen July has been fairly good, and we've seasonality wise we've closed on a very positive note on the month of July. We are still seeing very strong support based buying here, which indicates that there is a very good base made by the put writers. So even at these levels, I would recommend a buy here with a target of 25,350 immediately, and then 25,500 levels, and 25,100 would act as an immediate, support, which will act, for tomorrow's expiry. But 25,000 is a positional level, which will be crucial to watch out for the monthly expiry. So yes, it is definitely a buy from here, with, of course, stop losses to be traded upwards.
Okay. Just let me go across to a quick NDTV Profit exclusive, important one actually. Smartphone makers are optimistic as government plans to resume Chinese tourist visas. I think the two stories rolled into one here. Rishabh, let's start with what you've been covering.
Right, Tamanna, what we've been picking up on all of this is the fact that smartphone makers are seeing, of course, this Chinese tourist visa issuance being opened up. It is a positive as well for business visa issues, business visa issuance coming in. Why that is because firstly, it will sort of boost the sort of direct connectivity plans that there were between Beijing as well as New Delhi. The tourist visas are the tricky part because for Indians heading into China, it was easy. China did not ban any sort of entry. But for people wanting to come to India, the Indian government had imposed certain restrictions. Business visas were only available for those companies that were covered under the PLI scheme. So that is now set to be liberalized. A lot more talent could be seen coming from China. On this entire issue of, we saw how that Foxconn issue blew up with respect to talent being recalled. What we're seeing on that is that was a tactical sort of a move, but it was very limited in terms of scale and scope because only about less than 500 employees across various smartphone makers were recalled. So in terms of scale, it wasn't much, but it was tactical. And that is also seen as improving going ahead. You had External Affairs Minister S. Jaishankar also visit Beijing, and that was seen as a very positive sign of relations thawing between the two countries. So also what we're picking up from industry sources is the fact that if these issues continue to remain the way they are and they sort of are on the path of resolution, then India is very much on the track to become the world's second largest smartphone exporter and surpass Vietnam in that game, only to be left behind China. So that is what we're picking up from industry sources. Positive mostly. All of this, remember, comes when last Friday we reported on a letter that was sent by an industry body, the Indian Cellular and Electronics Association. This is a leading body of smartphone manufacturers here in India. And they had written to the government highlighting three major informal Chinese sanctions that had come in, one on talent being recalled, two on
so you have to look at this as a chain of events. Thank you for that, Rishabh. Important story there, and we've been reporting that you might see a loosening up of nod coming in from the government as well to at least 6 to 7 companies. We spoke to Dixon about it today, Neeraj, and they talked about that they're waiting for those nods
for this to come.
Just roll back to the story of Foxconn engineers suddenly upping and leaving a few weeks ago. Okay, so I'm just trying to follow the trail over there of the news coming in, and I think there's a serious negotiation which has perhaps gone on behind the scenes. This is the outcome, and it's a very pragmatic view coming in that these two nations, the two largest economies in the world and most populated economies in the world, have to collaborate on some very key factors.
Yeah, can't be on the opposite side of the fence on everything under the sun. So I think, well noted. And as long as it's a win-win for both, why not?
So let's pull up Dixon. Let's pull up Dixon because Dixon has reported today and very
wasn't
good.
the day's highs actually, just about a couple of hours ago.
Yeah, so let's pull up the Dixon chart and maybe we'll get you that conversation we had with Saurabh, the CFO, also in some time from now. A little off the day's highs, but yeah, nearly 3% up. Jefferies also has a note out on Dixon. They've upgraded the stock to hold and hiked its target price, which is way below its current market price, so no point there. But it's been quite a bit of a blockbuster Q1. Puneet, let me come to you on what Jefferies is saying, with the point of view also of what Dixon has told us today about its 5 joint ventures with various Chinese companies. It's waiting for permission in 3 out of those.
Well, definitely, and the talent is one of the key aspects for Dixon, which they highlighted in the call as well, that they've already hired a few people, but they want to hire a few more people which are expats from both Taiwan as well as China. So the story is very timely, to say the least. For Dixon as well, they did report a 95% revenue growth, and the note from Jefferies is largely they had some valuation concerns because business remains very solid. They, as you rightly said, upgrade to a hold from an underperform, still maintaining target price of 15,400. That's hiked from 13,300 earlier. 2 key points they're making: a very strong quarter is what they've said, along with the mobile revenue growth. But they've gone on to say that the mobile volumes are expected to double from 30 million in FY25 to 60 million over the next couple of years in FY27. They are factoring in this beat of Q1 performance and raising the EPS by roughly 3 to 4%, and now anticipate a 44% CAGR over the next 2 years for Dixon Tech, and hence the upgrade from Jefferies. And this is in line with what the CFO told us in the morning as well on doubling the smartphone volume as well as the components play, which he highlighted on while speaking to NDTV Profit as well.
Okay.
Yep. Thanks a lot for that, Puneet. And the point is, as Tamanna was saying, Puneet, thank you for that. We spoke to Saurabh Gupta earlier, right? And he spoke about how the point being that there's a strong order book coming in from the mobiles division, which led to the growth in Q1. That and more. Listen in.
We had a very strong order book. The momentum continued in our mobile business, which continues to be the largest piece for us. We see that momentum continuing in Q2 as well. Of course, our other verticals on washing machines, refrigerators did really well. And yes, we expect a strong order book. We have a strong order book ahead of this festive season in Q2. And there are some more customer acquisitions lined up. Third is our foray into this backward integration component should start playing out. Some of them will start playing out by Q3. Some of them will start playing out by Q4, Q1 of next financial year. So yes, we are sitting on a huge opportunity and exciting times ahead for us. Gradually and slowly, we'll keep taking some grabbing some export opportunities in mobiles, in lighting. So that also is on the anvil. And clearly, yeah, we are sitting on a very big opportunity right now.
So that's the opportunity coming out right now, and in fact we spoke to them very clearly about what their margin guidance is looking like, because while all numbers for Dixon were fantastic, their margins were completely flat at 3.8%. The word there is by FY28 you'll see about 135 basis points of incremental margin coming in as their backward integration and all of their contract manufacturing JVs start kicking in. So that's the Dixon story there. But what about the valuations? Amrish Baliga, we asked you this question yesterday, if I'm not mistaken, and you said some companies, and you were speaking in the context of Eternal, you said some companies you don't need to you shouldn't look at the valuations for all companies. Is Dixon in that category?
To a certain extent, no doubt, but not exactly like Eternal. Eternal is different. But here, I think, like we are talking of huge volumes, huge volume growth. So I think the margins will follow. Like the management said, I think the margins should follow in the next possibly 6 to 8 quarters. And when we're talking of this, I think currently they have managed the supply issue. So the visa announcement, the JVs, I think will have a positive effect on the output of smartphones. But then what about the projection of the demand? because whatever orders they'll be receiving in the next couple of quarters would be actually based on the demand projection for FY27. And what I believe and I heard is that the projection demand for smartphones in FY27 is much better than what we are seeing in FY26. So that's another I think positive for Dixon. So overall, I think this should be on the buy list, but may not be at the current levels. I think one should wait for some sort of a correction, whether it's a market correction or whether it's some news flow because of which Dixon would correct. I think you should utilize that to buy.
Okay, well, it's 2.72%, and EMS is certainly the sector which is, you could argue, in focus too. What else? Today, when you look at stocks which are trading close to or at 52-week highs, Fortis fits the bill, couple of percentage points higher, and at the day at 52-week highs. GE Vernova TND at 52-week highs. We spoke about ICICI Bank. The one that has really done well is JM Financial. I don't know if it's got to do with the fact that they've been bankers to so many of these block deals and IPOs that the investment banking revenue for JM could be high, or is there some other reason? But that stock is up about 5% in trade today as well. And L&D Finance Holdings, the one that came out with numbers a couple of days back, is high. Lastly, we spoke about cement, and your Parag Thakkar said that he might be taking skimming money off the table, and maybe that's why Ramco may be down. But Ramco Cement at 1200 is very close to its all-time highs as well. Shivangi, 4 or 5 names out here. Any of these that fit the bill for you?
Cement space, of course, we've seen a lot of action of lately, but the stocks are still, we've actually seen a good steam up in the last 4 to 5 weeks. And Ramco Cement is actually one of the preferred pick, which is stronger out of the entire lot, and we could actually see. But then, of course, we've seen a good rally, a good wait and watch over here. A good consolidation would make a base and a good risk reward for this one.
In which case, Shivangi, what is your top BTST idea or STBT idea as the case may be? 5 minutes left.
So first up is, of course, Bajaj Finance, which has been an outperformer in its own space. And we've seen that the stock has consistently performed in the last 5 to 6 months, making higher top, higher bottom over here. Even on the daily basis, we've seen that it has tested its 50 daily exponential moving averages roughly from the last 150 trading sessions, taken multiple supports at this zone. And we've seen that the stock has actually accumulated good volumes while it was rising in the last 4 trading sessions. So this one is a buy with a target of 1000 and a stop loss of 950 levels. Second pick is Tata Chemical. We've seen that this one has witnessed a good short covering move, followed by long build up from the last 2 sessions. And we've surpassed its previous hurdle zones of around about 960 odd levels, and we've seen that there has been excellent follow-up buying even from the lower levels. In the last 2 trading sessions, we've seen a good pullback move. Tata Chemical has started to come out of its consolidative band of the last 5 weeks, and so we're recommending a good up move here with a target of 1010 and a stop loss of 950 levels.
Amrish Baliga, somebody's talking about how the FNO activity is very, very high today. Apparently at 10:35 a.m., I haven't analyzed this data, but it's coming from somebody who looks at markets very closely, that the 25,200 strike, and maybe Shivangi, you might have a view here, the open interest was 6.3 million at about 10:35. This is about 16.5 million as of 2:15. Even on the call side, 20 million calls were open at 10:15. Those fell to about 7 million as of 2:05 p.m. So this is not retail activity. I mean, what's happening here? Any thoughts here, Amrish Baliga? Very quickly, 20 seconds.
No, I mean, clearly, I think the downside for the market is quite limited from here. I mean, again, I'm not really talking about F&O, but overall, that 24,800, I think, is a very, very good support level for the market. And with the way the liquidity is coming in, despite the sort of negativity as far as the geopolitical issues are concerned and the sort of global news flows, despite that, if our markets are holding on, then I think it's very clear that I think the downside is very limited from here, whereas the upside can be the earlier highs which we are seeing.
Got it. Shivangi, very quickly, 20 seconds. Retail activity, or does this kind of look like a very heavy insti activity today on the call and the put side.
So of course there has been some sort of unusual activity happening. We've seen India VIX also sinking below 10.5 levels. So there is a mix of institutional as well as retail activity here. But of course the buying can be seen very strongly with the unwinding seen at the higher levels of call writers.
Okay, thank you so much, both of you, for joining us this afternoon, giving us all of those views. Let's quickly zoom in, see what's happening in markets, because it's been a really solid day of trade. We've recovered well from the lows. The Nifty's done well as well, around 0.6%. I reckon we're closing very close to the day's highs, 150 points up on the Nifty, 0.8% higher on the Bank Nifty. So that also driving the index higher. Let's pull up the intraday on the Nifty 50. That'll give us perspective. Very, very close to the day's high on where the Nifty is closing in at. Let's look at the heat map. Try and get some perspective. The breadth, of course, strong. So that's one factor which is aiding markets. The other one is some of the heavyweights participating today, and I'll pull out the contributors in just a moment. Tata Consumer in focus on the back of numbers which will come out. HUL, Infi as well in focus. So Infi and Tata Consumer, 2 out of the top 3 losers on the Nifty pack on a day like this will have numbers coming out. So something to keep in mind. But Tata Motors, 2.6% higher, was the top gainer in trade today. Outside of that, some auto names as well. We've closed for the day. Bajaj Auto was one. Auto financing names also doing well. To some extent on the way in which M&M Finance also delivered numbers. The growth doesn't seem to be all that bad. The asset quality problem doesn't seem to be all that bad. So all of that seems to be playing out to a certain extent. Maruti also up 1% in trade. Let's look at the contributors on the Nifty as well. Reliance was up around 0.9%. HDFC Bank is the other one which has contributed well on the index today. Bharti and ICICI are the other 2 heavyweights which have done decently well. Infi, HUL, well, just very, very small contributions. Not going to talk too much about that. Sectors, let's pull that up. And I'd be curious to know where auto has closed. Well, auto up nearly 1% in trade. One of the top gainers. Healthcare is the top gainer. Nifty Bank up around 0.8%. Fin Nifty driving that. Private banking index doing fairly well for itself. The PSU banking index, which has been subdued over the last couple of days, also up around 0.5%. The Nifty Pharma, and you'll have DRL come out with numbers as well. That'll have some impact on the Nifty Pharma index tomorrow. So you want to keep your eye out on that one as well. FMCG and Realty are the 2 indices which have closed in the red. Not surprising given the kind of names that we saw on the Nifty 50. The Nifty Realty has closed over 2.5% lower. So that's where a large part of the pain today resides, and that's of course within broader markets. Let's look at the advanced decline. I reckon that would have improved. The market breadth would have improved right at the fag end. It has. 1:1 is where we close in at over the last hour or so of trade. Let's pull up the Nifty mid cap and small cap. There has been some bit of underperformance, but look at that. Look at that move in the last hour or so of trade. 1/3% higher on the Nifty mid cap. The small cap index also closing a nice 1/10%, but nonetheless, making that nice little move right at the fag end. So a decent kind of move at the end, despite it being a dull day for a larger part. I want to look at the BSE 500 top gainers, top losers, and those are some names in focus. And MRPL, a credit access on the back of numbers. JM Financial doing well as well, 5% higher. DCM Shriram, Lakshmi Organics, Godrej Agro, all of those names on the list. Loda is the one which is the top loser, dragging the Realty Index down. Along with it, AB Realty also. Numbers were out, and that reaction on the stock. Z Entertainment, post the management commentary, is staring at a 4% down today. 4% lower on a Colgate as well that we saw today. A Brigade, among others, and a Prestige dominated by real estate. The losers, at least in trade today, and that is reflecting on the Nifty Realty Index as well. 2.5% top sectoral loser. Let's look at what all to watch out for tomorrow, and there is plenty. Those are some adjustments for you. The large dividend by UTI asset, you will see that adjustment happen tomorrow. Crompton Greaves, Hudson Agro are the other 2. Let me also call out another couple of stocks, Hero, Radico, as well as TCPL Packaging. All of those three also in focus on the back of dividend adjustments. There'll be that rights issue by Spandana, which you will also get to see, which will open tomorrow. Let me also take it to some of the earnings, and these are earnings today, and some of the larger ones coming in. Bajaj Housing, Bikaji. Then you'll have a couple of big ones also, something like a Dr. Reddy's, a Force Motors, which has been a solid performer, will also come out with numbers. Coforge expected to deliver solid PAT growth. Maharashtra Scooters, I believe the numbers were out. Oracle Financial Services, the numbers also will be looked out for. I also want to pull out an Infi because that one's numbers will also be expected later today. So that's the other big one which I will be looking out for. Tomorrow though, tomorrow is another big day. SBI Life within the Nifty 50 pack, Bajaj Finance within the Nifty 50 pack. Those two will declare numbers as well. Bajaj Finance will have a knock-on effect on Bajaj Finserv. Among the NBFCs, it will be REC. Nestle will be the big one within the consumer basket. Adani Energy and Ather will be the other two. But let's keep flipping forward, and okay, so that's what we have in terms of earnings tomorrow. Lot to anticipate, lot to watch out for, but for the moment, we've closed for the day. We'll close India market close as well. Thanks so much for watching from Tamanna, Neeraj, myself, everyone who puts the show together. But you don't want to go away because Market Express will take the action forward. We'll give you a wrap of everything that's happened through the day. Stay tuned.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है?
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real
Welcome, you're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight into the show. So viewers, benchmark indices bounced back to recover throughout the day. Nifty 50 ends trade close to its intraday high with gains of about 0.6% and the 30-pack Sensex followed suit to conclude over 500 points higher. Bank heavyweights such as HDFC and ICICI uplifted the frontline indices, while a little pressure was seen by the FMCG majors like the HUL and Tata Consumers. Most sectors ended in the green, with highest gains recorded by finance, auto and banks. On the losing side were realty, media, FMCG and defense. The market breadth ended trading as highly skewed in favor of the bears. Paytm reports its first ever net profit of 123 crores in the Q1 of FY26. So revenue rises 28% year on year to 1918 crore rupees, driven by merchant payments, AI-led cost cuts, reduce expenses by 18.5%, boosting EBITDA to 72 crore rupees. Shares climbed 3.4% as the fintech firm strengthens its market lead. Jana Small Finance Bank's Q1 net profit fell 40.4% to 102 crore rupees. High operating expenses and provisions hurt the earnings. So net interest income dipped 2.4% to 595 crore rupees. But other income helped, so the bank expects margin improvement and better Q2 performance. JSW Infrastructure's Q1 profit jumped significantly. Revenue rose due to higher cargo volumes. Operating margins also improved with strong earnings growth. The company plans major investments to boost capacity by 2030. KEI Industries Q1 profit soared 30% to 196 crore rupees. Revenue also grew 25% to 2,590 crore rupees, led by cables and wires. Margins dipped slightly due to a shift in the product mix. EPC project saw a sharp revenue drop. Denta Water secures new orders worth 183 crore rupees. So the orders cover irrigation, road and water management projects. So the company now has 21 ongoing projects. Its order book stands strong at 745 crore rupees. Kirloskar Ferrous Industries is preferred bidder for Jambunath iron ore mine. So the win ensures captive iron ore sourcing from pig iron production. Now the company's pig iron serves the auto, pump and steel industries. This strengthens KFIL supply chain and manufacturing efficiency. Oswal Pumps acquires 5.2 crore equity shares in the Oswal Solar Structure. So the deal worth 303.7 crore rupees makes it a wholly owned subsidiary. Oswal Solar Structure manufactures solar modules. Now this move strengthens Oswal Pumps' renewable energy portfolio. Shah Metallics reports strong Q1 results with higher profits. Stainless steel realizations rose 8.5%, aluminium up 4.3% quarter on quarter. So the company plans to raise 4,500 crore rupees via debt and equity. Board approves issuing 3,000 crore rupees in non-convertible debentures. Sri Lotus Developers files for a 792 crore rupee IPO. Bollywood stars Shah Rukh Khan and Amitabh Bachchan invest crores. Investor Ashish Kacholia also backs the Mumbai real estate firm. Funds will support luxury projects and subsidiaries. United Breweries report a 6% rise in Q1 net profit to 184 crore rupees. Revenue jumps 15% to 2,862 crore rupees, driven by strong beer sales. So premium brands like Kingfisher Ultra grow 46%, boosting volumes. Shares gain 0.75% after the results, despite a narrower margin. M&M Financial Services post a 3.2% rise in the Q1 net profit to 530 crore rupees. Higher provisions of 660 crore rupees, up 44.3%, hurt the profitability. So brokerages like Jefferies and Macquarie flag concerns over the credit cost. Shares remain under pressure with a cautious outlook for investors. Dixon Technologies shares jumped 3% after strong Q1 results. Net profit soared 68% to 225 crore rupees. Revenue also up 95% to 12,836 crore rupees. Brokerages like Nomura and CLSA are bullish, but Morgan Stanley flags risk. So the mobile segment drives growth, though valuations remain high. Jefferies turns cautiously optimistic on Dixon Tech, upgrading the stock to hold and hiking its target price to 15,400 rupees. So the electronics giant delivered a blockbuster Q1 with profit doubling year on year and mobile volumes also surging.
Dr. Reddy's Laboratories is set to report steady growth in its first quarter results. The company expects revenue to rise 13% to 8,693 crore rupees, up from 7,696 crore rupees. EBITDA is also projected to increase 9.4% to 2,332 crore rupees, though margins may narrow slightly to 26.8% from 28% last year. Net profit is forecast to grow 8.7% to 1,514 crore rupees. Growth is driven by strong performance in India, Russia and other markets. And, viewers, we are getting to know that Infosys is out with its quarter one results, and I'm joined by my colleague Puneet here in the studio. So, Puneet, what are you picking up? What are the numbers suggesting?
Well, it looks likely a decent performance actually from Infosys in this particular time frame. We've seen the revenue for the company also come in quite in line with estimates. 42,279 crores is what we have. What's the actual number? We were going with 41,741 crores. So it looks like a beat on revenue. When you look at the EBIT performance of the company as well, 8,800 crores, again beating estimates of 8,700 crores. Margins were expected to come in at 20.88%. Likely it's come in at that range only, so again a beat there. And in profits as well, we were expecting a fall of about a couple of percentage points, and that has also largely come in much better than what the estimates were of about 6,700 crores. The number has actually come in at 6,900 crores as well. Just for, in this aspect, it largely looks in line in terms of performance for these four numbers. Let me actually get in Sushovan Nayak as well, the research analyst at Anand Rathi Institutional Equities. Now, Sushovan, a very good afternoon to you and thanks so much for joining in. Just in terms of the first four numbers, in terms of revenue, EBIT margins as well as profit, it likely looks largely in line. Would your assessment also be the same?
So, hi, I hope my voice is audible.
Yes, Sushovan, I can hear you. It's Puneet this side. Go ahead, please.
Perfect. Puneet, so basically, if we look at the constant currency growth of 2.6%, I think that is something that is a very good number. I think it's better than expected. That is one. And the other bit is the company has also raised the guidance from 0 to 3% to 1 to 3%. The lower end of the guidance has also increased, both of which I view are positive. So overall, I would say the numbers are better off than expected. It is a TCV is something that I am looking at that number as we speak. Yeah. So that
please go ahead.
Believe that's 11.3 on a LTM basis and 3,800 in 1Q FY26, which is better than last quarter, which is also a positive. And on a trailing 12-month basis, it is almost flat versus last quarter. So overall, it looks a good set of numbers.
So, Sushovan, in terms of constant currency, 2.6%, you rightly mentioned this is above estimates from consensus. What was the number that you were working with?
We were working with 1.3% actually.
1.3%.
So that's why it is, because that number is very good, and that's why that was the first thing that I was looking at.
Correct. And in terms of, you rightly also mentioned the deal wins as well. Over the last 3 quarters, this largely been hovering between $2 to $2.5 billion. This time 3.8, in line with, as you rightly said, on a YOY basis as well. So that number also seems positive in terms of versus what your estimate was. How is that number looking at?
No, so if you look at the last 3 quarters, it has been always hovering between the around $2.5 billion. 3.8 is actually a very good number because last quarter, if you look at it, the numbers were in line, but this time it has beaten on a trailing 12-month basis. So the deal wins are looking very good. But obviously, this is just the initial view. We'll just have to go through the fine print of that.
No, absolutely, Sushovan, and we appreciate you joining in as well. I just wanted to ask you in terms of the guidance as well. Now, they have increased the lower end of guidance, similar to what the HCL Tech has also done. But there were a lot of consensus estimates of 1 to 4% of the guidance from 0.0 to 3%. What do you make of that? Do you think that the upper end being largely stagnant at 3% is slightly disappointing, or is that something that we were wishing too much from this result?
I I believe the 1 to 3% is fair. In fact, that is exactly what we had built in, that they would move it to 1 to 3%. But given that, there is still an overhang of uncertainty and tariffs that are going to come, so I think it's a conservative guidance, and we'll see as it evolves over the next few quarters, right? So as of now, I think that's a very fair thing that is from a guidance standpoint.
Right, so Shwan, and we've actually seen in this particular quarter revenue growth across some key verticals. We've actually also seen the manufacturing vertical coming at 6,800 crores. Last quarter, the revenue was 6,500 crores. The other vertical which was hampered was retail. So that's coming at 5,600 crores versus 5,400 crores as well. So Shwan, my large question is basically from the press conference as well as from the conference call. What are some of the key aspects that you will be watching out for in terms of segmental performance for this quarter?
I would actually want to look at BFSI just to see how exactly is it going in life sciences, because a lot of large cap IT peers have basically mentioned that there have been some stress in the life sciences thanks to the payer environment. That is one. And the other would be high tech, because high tech is seeing some green shoots across the large cap IT players. This is something that I would also want to see more from a guidance perspective, what's happening there from the management. And obviously retail and manufacturing would be good to understand what's going on, but as you rightly mentioned, it's been more or less quite a negative commentary across most of the players, I guess with the exception of LTI.
Right. So, some more comments coming in that the operating margin largely seen at 20 to 22%, and that's something that has been known for a few quarters now. But so, Shwan, just to wrap, you think that the numbers are largely in line, is that correct?
Yeah, the numbers are largely in line. In fact, the revenue, I was pleasantly surprised, the constant currency growth, because that is a number which I was looking at. At the end of the day, it is growth that would, differentiate the players, because everyone else has shown a negative constant currency growth in the large cap IT space with the exception of LTI. Right.
Fair point, Shwan. Thanks so much for joining in, giving us perspective on a whole host of information coming in at a very thick pace. So thanks so much for joining in. And that's largely, viewers, the key aspect of Infosys. The numbers largely seem in line. Revenue growth positively surprising on a constant currency basis. Deal wins positively surprising on both on a quarter-on-quarter basis and on a year-on-year basis as well. While the number was at over 3 billion last year, 3.8 billion for this particular quarter is also very strong. We have the press conference scheduled at 4:15, and that's one of the key lowdowns, Himakshi, of that. It's a result that will positively surprise the market because of the performance versus other large cap IT players. Yeah. So definitely a very strong result for Infosys.
Yes. Thank you so much for breaking down those numbers there, Puneet, for our viewers. And with that, let's proceed further with Market Express. So, viewers, Dalmia Bharat also reported a mixed quarter-one performance with flat revenue growth, but sharp improvement in the margins. Revenue edges up just 0.4% to 3,636 crore rupees. However, EBITDA rises a robust 32% to 883 crore. But, viewers, we're going to go back to my colleague Puneet because he's going to, add up more to the quarter one results there. Puneet, what are you picking up?
Just looking at the segmental performance and, to come in as well, because it's a key result that we just spoke about in terms of constant currency as well. Infosys being the only one that's actually reported a positive one. And that's something that, Sushavan also mentioned as well, of almost 2.6% growth on a constant currency basis. In terms of segmental performance, and I just wanted to highlight that for a bit, and Sushavan also did highlight essentially what that could be. The financial services aspect was positive of 11,796 crores was of the financial services business. Compared that with what happened in the previous quarter, 11,600 crores. So financial services, as Sushman also highlighted, was positive. On manufacturing, the revenue has improved. On energy utility resources, it's coming at 5,700 crores, again improved from the previous quarter. And high tech and life sciences also have improved on a quarter-on-quarter basis. So we'll be getting in more perspective on this, post, the press conference that's slated to start at 4:15 as well. But a lot of stocks, Himakshi, that were in focus on the back of results as well.
Yeah, Praneeth. So, Puneet is right here. He will be getting us all the updates as and when they are coming, and we will be catering it as and when the updates are there. And with that, let's proceed further with the show. So, talking about the brokerages note, so brokerages are kind of sharing mixed views on Colgate-Palmolive. HSBC has also cut its target price for Colgate to 2,600 rupees there, maintaining a hold rating. They also cite a more significant moderation in the performance than anticipated, with Colgate expecting only a gradual recovery in the second half of the fiscal year 2026. So HSBC believes that while some improvement is likely, the structural growth potential for the company remains low. And on the other hand, JP Morgan has trimmed its target slightly to 2,625 rupees but maintains an overweight rating. They acknowledge a tough first half for Colgate but anticipate a back-ended recovery in the second half of FY26. With volumes growth expected to improve, JP Morgan also projects that EBITDA margins will hold strong at 32 to 33%, though they have reduced their FY26 to 27 earnings per share estimates by 6%. So investors are weighing that these differing outlook as Colgate navigates is, its current market. Tata Consumer Products is also poised for double-digit growth, viewers, in its Q1 results, with revenue expected to rise 11% to 4,812 crore rupees from 4,352 crore rupees last year. So, however, EBITDA is likely to fall 3% to 648 crore rupees, causing margins to contract to 13.4% from 15.3% due to inflationary pressures and tea price increases. So, profit after tax is forecast to surge 23% to 356 crore rupees. Volume growth is expected in the mid-single digits, with India food segment and salt category driving performance, while beverages face tepid growth due to unseasonal rains. The international business is also expected to remain under pressure. Overall, Tata Consumer delivers strong top line and profit growth but faces margin challenges in the Q1 of FY26. Coforge is also set to announce strong Q1 results, with revenue expected to rise 9.3% to 3,727.5 crore rupees, while EBIT surges nearly 25% to 502 crore rupees. Now, margins are forecast to expand to 13.46% from 11.78%. This is driven partly by the sales of the loss-making Advantage business. Now, net profit is also predicted to grow 27% to 331 crore rupees. Constant currency revenue growth is estimated at 6.8 to 7.6%, with organic growth around 5% quarter on quarter. Investors will focus on updates regarding the Sabre deal, particularly any initial cost impact and the progress on the acquiring Cigniti. So, additionally, strong deal wins continue, with bookings expected near $500 million and an order intake of $2.1 billion in the previous quarter. So, underpinning confidence in the Coforge's growth trajectory, the board will also consider an interim dividend alongside results today. Orient Pro Solutions stock was on the back foot after a weak equipment segment performance. So the company still shows strong growth with a 1,460 crore rupees order book and 16 new clients. So it signed a major deal with the top African bank for its digital platform. Q1 revenue also jumped 28.7% to 337 crore rupees, though margins dipped slightly. Cyient DLM's Q1 FY26 revenue rose 8% to 278 crore rupees, driven by strong aerospace and defense electronics growth. However, the net profit fell 29% to 7.5 crore rupees due to a less favorable revenue mix and soaring cost. Employee expenses surged 78% to 57 crore rupees, and other expenses jumped 140% year on year. Despite this, EBITDA grew 25% to 25 crore rupees, with margins improving to 9%. Syrma SGS Technologies Q1 of FY26 net profit surged to 49.7 crore rupees, which is up from 19.3 crore rupees last year, despite an 18.6% revenue drop to 944 crore rupees. So EBITDA has jumped 90.6% to 86.6 crore rupees, with margins expanding to 9.2% from 3.9%. So the Chennai-based electronics manufacturing firm benefited from a focus on high-margin industrial and auto segments. The company remains on track for 30 to 35% revenue growth in the FY26. President Trump announced a major US-Japan trade deal. it cuts tariffs on Japanese autos to 15% from 25%. So Japan will invest $550 billion in the US, including an Alaska LNG project. So the deal boosts trade, with Japan opening markets to US cars and agriculture. Well, with that, viewers, it's a wrap on this edition of Market Express, but please don't go anywhere as we have Profit 360 on the other side of the break.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसा हल्का सा भी खौफ नहीं है.
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and
Benchmark indices surge ahead of broader market peers during the session. The Nifty 50 rallies 0.6%, fueled by strong performances in the financials and auto sectors. Infosys posts its first quarter revenue and profit in line with expectations, bolstered by a robust large deal total contract value of $3.8 billion. Trump completes a massive trade deal with Japan as US imposes 15% reciprocal tariffs on the nation. Japan will invest $550 billion into the US and it will receive 90% of the profits. Meanwhile, India will formalize the free trade agreement with the United Kingdom during Prime Minister Modi's visit to the UK. A 3-year exemption from Social Security, contributions for Indian professionals temporarily working in the UK and their employers seen to be a key win. Technical glitches at MCX were building over 2 to 3 months, say sources, adding that the exchange was aware of them and was in touch with members, but they persisted. In a big relief for SpiceJet, Supreme Court dismisses the plea of Maran-owned KAL Airways seeking 1,300 crore rupees in damages, upholding the Delhi High Court's order dismissing the claim against SpiceJet. Myntra comes under ED's lens for alleged FEMA violations. The complaint filed for an FDI breach of over 1,600 crore rupees. Bollywood royalty Shah Rukh Khan and Amitabh Bachchan join ace investors Ashish Kacholia and Jagdish Master in backing the 792 crore IPO of Sri Lotus Developers and Realty. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest in markets as well as national and international news. So let's dive right into it and have a look at how the markets fared today. We saw some strong action, but select financial and auto stocks driving the benchmarks higher, even as broader indices showed mixed trends. Real estate and FMCG faced visible profit booking, while several sectors such as oil and gas, pharma, PSU Bank and IT reversed their losing trends. Here's Harsh with all the details.
It was a very interesting day of trade. We've breached a couple of key levels. We were just above the 25K mark, but we breached 25,100 and thereafter closed above 25,200. So we had a good day of trade overall, 0.6% higher on the Nifty 50 index, largely driven by financials and banks. So that was the pocket which did well. And it wasn't a day where either or private versus PSU participated. It was both which did fairly well for themselves. The PSU banking index was up 0.5% thereabouts. The private banking index obviously did much better, 0.8% higher on the Nifty banking index. So a decent day of trade where the banks are concerned. The other pocket which kind of did well was the auto space. You had some names which did extremely well. The top gainer was a Tata Motors, followed by a Bajaj Auto, which did fairly well for itself as well. Hero was in the fray as well. So the auto pack was the other one where there was some bit of zing. If at all any, it was FMCG which was languishing at the bottom. Tata Consumer earnings today, but one of the top losers in trade, and along with it you also saw the likes of an HUL and ITC, all of which were languishing at the bottom in terms of the Nifty 50 pack. I'll quickly switch to sectors and kind of already covered it to a certain extent, because some of the top gainers were within the financials, but outside of that you saw the healthcare index being the top gainer today. Not too much there, but that was the one top gainer. Outside of that it was of course the financials, the auto, the Nifty auto which took lead and did well for itself. The top loser today within the broader markets was the Nifty Realty Index, down over 2.5% in trade. So that was the one big loser, and it was led by the likes of a Loda, which was Macrotech Developers. You also had a Prestige among the top losers within the BSE 500, and Oberoi, where there were block deals also seen. So some of those names dominated trade. In terms of the other big loser was of course FMCG, 0.5% lower on the Nifty FMCG index. We did see some of the names not doing as well, and that was reflecting on the index as well. Let me talk about the breadth. The breadth was decent as well. We for a large part of the day we consolidated 1,200 losers to 1,000 gainers. Thereafter we closed 1:1, around 1,100 each is where we closed in at. A fabulous recovery that we saw, especially in broader markets. The Nifty small cap and mid cap indices did fairly well towards the fag end of the day. We saw a decent recovery from the lows, so we saw that play out really well. And that was carried forward by the Nifty, that kind of reflected in broader markets as well. So it played out well. In terms of the BSE 500 top gainers, top losers, a couple of names from within the financials pack, broader markets, JM Financial, Credit Access did well for themselves on the back of earnings. Largely was Credit Access's reaction, or rather the commentary rather than earnings. And in terms of the losers, dominated by the Realty Index players, and some of those players really seeing or rather really getting beaten down today, and that reflecting on the Nifty Realty Index as well. So broadly that's how we played out.
Thanks, Harsh, for that. Meanwhile, we also spoke with Nitin Bhasin of Ambit Capital, who said foreign investors are currently cautious on India, mainly because they view Indian stocks as overvalued. But he's not overly concerned, because he also said that he believes foreign investment inflows into India are still strong and positive. Let's play that out for you.
If you look at the Nifty X banks or Nifty 100 X banks, and what you could see is the whole market at the large caps relatively is expensive. But, you know, markets don't move to valuations. Markets also move to what is the expectations and how are the market results coming out or numbers panning out to the expectations. And clearly, one has to follow what's happening on the upgrade or the downgrade cycle. With sectors, what's happening to the upgrade and the downgrade cycle. So clearly, what we are witnessing right now is though banks may be relatively inexpensive, performed very well in the last 1 year, but they are going through their own June quarter, perhaps even September quarter to some extent, sort of a moderation in credit growth, continued pressure on NIM or expected pressure on NIM, and hence margin pressures possibly over there. So I would say mid cap, small cap appear relatively more expensive to large caps. Overall, the whole market to its own history is expensive, but the flows in India, remember, we have keep on talking about this in the past, that flows in India are strong, which is domestic. Hence, that is the elevated new price earnings multiple of India.
Right, let me quickly go across to my colleague Puneet now to look at the big earnings of the day. Infosys' Q1 profit that met estimates, and IT major also revising its FY26 guidance. Puneet, give us the detailed analysis. Over to you.
Well, thank you for that. So revenue was definitely coming at a very strong click, almost 42,279 crores. It's a 3.3% growth compared to the previous quarter, and that's much above the estimate of about a 2% gain that was expected. So it's definitely a beat there in terms of the EBIT as well. The margins have come in at 21%. Estimates were baking in roughly about 20.8% as well. So again, a number that's bang in line with the NDTV profit estimate. In terms of profits, it's coming at 6,900 crores. It's a fall of 1.6%. But we were going with a larger fall of about 2.5 to 3% on Infosys. So at least on these 3 to 4 broad financial numbers, it is a beat, and Infosys has been the only large cap IT company to report positive constant currency growth. So they've come out with a constant currency growth of 2.6%. Just for viewers' perspective, constant currency removes any kind of fluctuations across different currencies that these IT companies handle in, which could be the dollar or the pound amongst other currencies. So that has been the highest at 2.6% for Infosys in this particular quarter. There are also other two key updates. One is, of course, of the guidance, as you rightly mentioned. It was 0 to 3% for FY26. Infosys has increased the lower end of the guidance now, so it's now 1 to 3%. So anticipating at least 1% growth. Most of the brokerages were going with this number, but there was some that also expected the upper end of the guidance to be raised to 4%. So 1 to 4% could be one of the key reasons, and we'll see if the management speaks about that. And finally, in terms of deal wins, it's a huge surprise: $3.8 billion in deal wins compared to the previous quarter, which was around $2.5 billion. It's a big jump for the company, and they've had 2 renewals, a couple of other deal wins in this particular quarter that's boosted that. So definitely on the 4 numbers, on guidance, on deal wins, all 3 numbers in line, as well as beating estimates for Infosys in Q1 of FY26.
Right, Puneet, thank you so much for that update. Infosys' Q1 profit indeed meeting estimates and updating the FY26 guidance. Thanks so much for that. Moving on, the State Bank of India has closed its record-breaking qualified institutional placement, raising over 25,000 crore, the biggest ever in India. Listed today on the NSE, the QIP drew a massive 1.12 lakh crore in bids, with 64% of that from foreign investors. SBI Chairman C.S. Sethi revealed this. My colleague Vishwanath Nair caught up with him to discuss this milestone. Let's listen in.
So the growth chapter has been wonderful. I think it's not only about the short-term growth strategies. The long-term objective of SBI always has been to position itself as a preeminent bank and play an important role in India's economic growth story. And I think that is not affected in any manner. That was not affected even earlier also, I think. But this capital raising reinforces the confidence of the investing community across the globe in India's story as well as SBI's story.
Meanwhile, US President Donald Trump has announced revised tariffs for Japan, the Philippines and Indonesia. Tariffs on Japanese imports will now drop to 15% from 25%, alongside Japan's commitment to invest $550 billion in the US, a move that has been praised by Japanese Prime Minister Ishiba as strengthening bilateral ties. Now, following the news, Japan's Topix index rose 2%. The Philippines tariff on exports to the US was cut to 19% from 32% following a recent White House meeting between Trump and President Marcos Jr. Meanwhile, Indonesia's tariff was slightly reduced from 20 to 19%. Meanwhile, B. Riley's Seth Freeman, who spoke with us earlier today, believes that the US government has been diligently working to finalize deals with various countries before the impending tariff deadline. He considers the agreement reached with Japan a significant indicator of positive momentum.
The volatility of various tariff rates is very positive, not only for the U.S., but for the global economies, because we saw the kind of disruption when the original tariff tantrum was announced several months ago. Yeah, I think the U.S. government's been working very hard to try to close deals by this August 1st deadline because it's not helpful and it doesn't look good for the administration to have not achieved many deals. So I guess we could look at the Japan deal and hope that this is a sign of some momentum, which would obviously, should a deal be cut with other emerging markets countries, that would be very positive.
Meanwhile, let me quickly go across to my colleague Rishabh, who's going to break down the current developments and their impact across Asia and also in India.
President Donald Trump, we saw about 3 major trade deals being signed with various Southeast Asian countries, Philippines, Japan, as well as Indonesia. Now, in terms of Japan, which is considered to be the largest of these deals, Trump will slash Japanese tariffs to 15%. This is in comparison to the 25% threats that were given by Trump to the Japanese. And also, this is tied to a $550 billion Japanese investment that will come into the US as part of the deal. We saw today Japanese markets also surged because of this deal. Nikkei surged about 2.6%. Mazda as well as Toyota, large Japanese automakers, also saw about 17 and 11% jumps in stocks. We also saw that, and this was on the back of the auto duty, the sectoral tariffs that US has decided to relax in the case of Japan. These will be slashed from 27.5% to 15%, and that is the primary reason why the likes of Mazda and Toyota jumped in trade. What we're also picking up is that Indonesia, that tariff has gone down from the earlier threat of about 32%. It went down to 20. Now it is at 19%. And that is also, in return, Indonesia will open up all of its markets to the US. That is what Trump claims. And what we're also seeing is that nearly all tariffs on US imports will also be dropped by Indonesia. Philippines, also a similar case to Indonesia. We're seeing a 19% tariff being levied there. This is below the 20% tariff threat that Trump administration had imposed. And also Manila offering zero imports to US, zero tariffs to US imports. That is a part of these deals. We saw in the run-up to August 1st, Lutnick as well as various other senior officials of the Trump administration, all of them had said that there will be a bunch of deals coming in, and now we're finally seeing a bunch of deals coming in, a major amount of deals in terms of the record number of investment that is being tied into as part of these deals. What we're also seeing is that these are somewhat skewed in favor of the US prima facie because these deals are primarily coming in from the US. So that is something that is to be seen with respect to India also as we track up to this August 1st deadline. What sort of a deal will India be able to achieve as we go ahead?
Right, thanks so much for that, Rishabh. Moving on, India's cabinet has given its approval to a comprehensive free trade agreement with the United Kingdom, marking a significant step in strengthening bilateral economic relations between India and the UK. Now, the agreement, like we've been telling you, encompasses a broad spectrum of economic and trade components and is scheduled to be officially signed during Prime Minister Narendra Modi's visit to London. Now, he lands there tonight.
The India-UK FTA is set for its formal signing on July 24th. Prime Minister Narendra Modi will sign it in the presence of UK Prime Minister Keir Starmer in London. Also in attendance will be, of course, Commerce Minister Piyush Goyal. Now, this FTA will not go into effect directly. It will first go to the UK Parliament. It is learned to have already been approved by India's cabinet. Now it will be approved by the UK cabinet, and that ratification process might take about a year or so. And after that, we'll see the operationalization of the FTA. Now, in this FTA, this was considered a landmark FTA, one of the largest ever signed by India. Also,
to the press conference of Infosys right after the company released its Q1 earnings.
Are helping our clients drive faster decisions, improve customer experience, and improve operational efficiency. Based on our performance in Q1 and our current outlook, our guidance for growth for financial year 2026 is revised from where it was 0% to 3%. Now it'll be 1% to 3% in constant currency terms. Our margin guidance remains unchanged at 20% to 22%. With that, Rishi, let's open it up for questions.
Thank you, Salil. We will now open the floor for questions. Joining Salil is Mr. Jayesh Shangarajka, Chief Financial Officer, Infosys. The first question is from Ritu Singh from CNBC TV 18.
Hi, gentlemen. Thanks very much for the question. You're talking about how the numbers have been very strong. The performance has been good. The first quarter revenue is above what the street had factored in. Two questions on this. If the numbers are so good, why have you not raised the upper end of your guidance? Why just the marginal revision from 0.3 to 1 to 3%? And how much of this, upward revision that we're seeing, and including the kind of constant currency growth, 2.6% in this quarter, has come from your inorganic, from your acquisitions that you've made? That's one part of the question. Also, how would you guide the street to look at these numbers? Would you really say this is a turnaround that you're seeing, in the current macro environment, that going ahead this kind of performance would be sustained? And a word, last time we didn't hear much from you on the whole tariff conundrum and how that is impacting discretionary spend, specifically in sectors like manufacturing, retail. What's your sense on, the clients? And, if you could also add a word on your hiring plans for the year. Thanks very much.
Thanks. So first, on the guidance, what we have seen this quarter is a strong performance in terms of where we have delivered the 2.6%, as you pointed out. With that, and with the current outlook, where we have seen a lot of the discussions on the economy worldwide having come to more stable situations, but still seeing that it's not fully settled. Given that, we've increased the lower end of our guidance as we go closer into the, progress into the year, closer towards the end of the year. We typically narrow our guidance, and that's the first part of what we've done, which is increase the lower end. We still see things within our guidance where we look at some things which will give us good traction. For example, what we've seen in the consolidations, we've seen very strong work that we've done on AI with agents, and we see that. And we also see the economy globally, both in Europe, US, going through changes. So keeping that in mind, we've narrowed the guidance and increased the lower end. On the inorganic part, I'll let Jayesh mention how much of it is inorganic.
Yeah, so inorganic in this quarter has been around 40 basis points within our 2.6% that we reported. And for the full year also, it will be similar number.
And then back on the sort of economy, we talked about it last quarter and also in addressing it today. There are overall changes in the economic environment, and we mentioned last quarter, we share that again. We see some of that impact, for example, in logistics. We see some in consumer products and some in manufacturing. But equally, we have seen benefits, especially because we've seen good traction with the work we're doing with agents in AI, and a benefit from consolidation that we've looked at, that the clients have looked at us and been positive. And that has given us some of the positive growth that we've seen in this quarter.
Would you call it a turnaround? Would you call it a turnaround, or this is an exceptional quarter because you got the benefit of the acquisitions? Also, you still ask certain about the demand environment.
So there, on the acquisition, as Jay shared, it's a small part of it. Even if you keep that aside, we are well over 2%, 2.2 in terms of constant currency growth in the quarter. The way I would look at it is it's very differentiated performance, because we have what we believe to be one of the best ways that we are deploying AI, enterprise AI, into our clients. So these are active projects where we are using agents, different types of agents that clients are leveraging, whether it's in their supply chains, in their customer experience, where they're getting productivity benefits, where they're getting improved customer service. That's one aspect of it. And the other aspect is we are seeing clients are selecting us more and more when they're looking at consolidation, because inherently we see clients see Infosys's delivery as very strong and stable, and also providing new ideas, especially on AI, for improvements into their business. So that's the differentiated performance that we are seeing in the way that we see it. Hiring.
So if you look at our hiring numbers, our overall headcount has remained constant at this point in time. Our utilization is at its peak at 85%. So we will continue hiring, and we expect to continue hiring in line with what we announced at the beginning of the year. There's no change there.
Thank you, Ritu. The next question is from Haripriya Suresh from Reuters News.
Good evening, gentlemen. One quick, I wanted to understand, America has growth has been sort of flattish, but Europe has grown really well. Just some color on the specific markets. Is Europe client specific? What is happening on that end? And, in terms of the employee headcount, like you mentioned, I know it's been flat, but I know there's a lot of talk about how Infosys is using AI. Do you see, if utilization's at its peak, do you see productivity increasing where you don't need to hire as much going forward? And will this sort of be the level that we will see it at? And I wanted to get some color on what the wage hike scenario will be for this quarter as well. Thank you.
So coming to your second question on headcount, as I said earlier, headcount has remained flat. Despite that, we've been able to deliver 2.5%, 2.6% on growth. Large part of that came from the RPP increase or the pricing increase that we got and the seasonality benefit that we got. 40 bips came from the acquisition, and the balance came from the volume increases, which we've been able to manage within our current headcount through utilization. Now that we are at a peak, any further volume increase will need to be, we do need to come from the hiring, right? So that's where we are. In terms of US and Europe, I think Europe has been strong footing for us for many quarters in the past. That's on the back of the investment that we made a few years back in Europe. We had identified Europe as a geography to invest into, and all of that I think is working well across sectors. And sorry. Is that geographical mix change between America and Europe? Because Europe is growing faster versus America, to that extent it's changing, but still US remains the largest sector for us, largest geography for us. Sorry, you had a third question. Wage hike. So we did a wage hike already. First wage hike, first part was that effective January. The second phase is already rolled out effective April. First, the impact of that is already baked in the margin of this quarter. We had 100 basis points of impact on account of wage hike, as well as the higher variable pay that we paid to our employees this quarter. So that's already done. Having done the wage hike very recently, next one we'll have to decide when.
Thank you, Haripriya. Next question is from Beena Parmar from the Economic Times.
Hi, Salil. You mentioned about the revenue being stronger. Some of your peers have pointed out that there has been some revenue cannibalization that they are seeing. Are you also witnessing it, and are you seeing some productivity gains, benefits that you're passing on to your customers? And is that also leading to change in pricing? I think we spoke about it briefly, but has there been any change in the first quarter? And secondly, is that also impacting your margins? What were the factors that led to the margins? Because I think it has declined. So could you...
So let me start on the revenue one. I think we are seeing with AI a lot of productivity benefits. We also saw productivity benefits that we were already working on from automation and lean, which were coming through. Typically, all productivity benefits, a part of that is shared with clients and a part of that is shared with us. We see, if you look at the overall level, what Jayesh was sharing, we have seen our productivity of our revenue, the way our own pricing is working at a macro level, improving. And this is more because we are doing work which is creating more impact, in addition to the productivity which is making some of that benefit being shared with clients. So these are two different factors, but on balance, we see an improvement into the quality of the revenue that we are seeing now.
So what kind of productivity gains you're passing on?
So there we are not discussing the amounts we are passing on, but in terms of what we're seeing as a benefit, we are seeing between 5% and 15% through AI programs where we are working with clients where typically there are disparate systems. Internally, there are some things we've done which are slightly higher than that, but those on internal, like if you look at our Finacle product, it's one uniform sort of a code base in which we can get better productivity. And the margin. Yeah, and on the margin walk, if you the 20 basis points of decline, the puts and takes of that, 100 basis points of headwind came from compensation related factors in hike that we gave in April, as well as the higher variable pay that we pay to our employees or we'll pay to our employees for this quarter. 30 basis points was a headwind on account of currency. And 20 basis points for other factors. This was offset by 70 basis points of pricing benefit that we got both seasonally as well as the benefit that Salil was talking about from productivity and everything that we've been doing under Project Maximus. 40 basis points came because of the acquisition related impairment that we did in the last quarter. That was a one-off in the last quarter, so that was a benefit this quarter. And 20 basis points because our third-party cost was lower. So just to highlight, our 2.6% of growth was despite the fact that our third-party revenue and costs were lower by 60 basis points.
Just one question, what conversations with the clients, has it improved in terms of the business demand? And, are you seeing that tariff-related uncertainty or the caution is now over and they are starting to kind of,
So on a macro basis, what we see is there are clients, all clients are quite focused on enterprise AI, where we can share what is working, where it's working, especially with agents. Then there are industries, specifically logistics, consumer product goods, manufacturing, where we see the impact of the changes in the economic situations. Where we were at this time last quarter, there's also been several things which have been done which gives more view and focus into what's going on, and yet there is still some open items which are going on. So we see, for example, from clients, there is quite a lot of attention on cost and efficiency of their own operations, even if they're not impacted by the changes in the economy. So that is all going on. Including some of the benefits that we're seeing from AI. And then finally, on a macro level, we at this quarter in our large deals, we've seen a lot of deals where we've benefited from clients making consolidation decisions.
Thanks, Beena. The next question is from Rishabh Shaw from Money Control.
Hi, gentlemen. Congratulations on a good set of numbers in a difficult quarter. In a difficult macroeconomic environment. I have a couple of questions. First on financial services. 2 fiscals back, you had close to 28%. Now it's down to 27%. So is this a new normal? Is this a change in composition, or are you losing market share? Second, your active number of clients has reduced in the last 2 fiscals. So and this comes on the back of revenue growth in this quarter. So is there a pricing change? What are the benefits? What's driving this? And also we see in the last 2 quarters that you have added in 3-digit numbers. So is this a beginning of moving from pyramid to IP-led businesses? Thank you.
So let me start with some of that Jayesh will add in. I think financial services, we are seeing a very strong traction. So one of the things we've benefited from in financial services is, if you look at, let's say, a large 20 clients, we have in half of them, we are the AI partner of choice with those clients. In many of those clients, we see benefits from consolidation. In many of those clients, we are in the forefront when there's regulatory change or big transformation, which includes tech and ops. So in senses, we are well positioned in financial services. We are starting to gain much more traction, and we have a broad set of coverage, both in geography and in capabilities within financial services. On the client. Yeah, so on the active clients, you always have a long tail. They come for small projects, and some of them eventually become larger projects. Some of them eventually fall out, and after a few quarters, few months, they come back in a way. So I don't think the active client is a big matrix. Of course, it's a matrix to track, but more important in our mind is the 100 million, 50 million clients, how they grow and how they mine that once they become a sizable client.
That's right. We'll continue bringing you updates from this presser after Infosys leadership addressed it post the earnings press conference. Thanks so much for watching. We'll slip into a short break right now, but all the updates on the other side of that break.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है?
मैडम एक बात को खौफ किस लिए रखना चाहिए ये तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है?
मैडम एक बात को खौफ किस लिए रखना चाहिए ये तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL?
Hello and welcome. You're watching KYC. Today we're going to speak about a cable and wire company which has come out with numbers, and honestly it does extremely well in terms of its return ratios. It's done 20% plus over the last 5 years in terms of ROCEs, and not just that, they generally guide extremely conservatively as well and generally exceed guidance. Now some of these cable and wire companies in India are doing extremely well, even in general given the macro tailwind, but this one is also going to do exports. So KEI Industries is what we're going to talk about. There's been a sharp ramp up in exports in Q1 FY26, and that is not just the only trigger, frankly. And what I want to know is the first piece is competition, because you have a couple of players who are likely making large investments in cables and wires in India, given the setup that I've just given you. High ROCs, very good macro and strong tailwind, and there are maybe just 2-3 large players in the space. So the opportunity size is also quite large. But is competition a concern? One, to the industry, but also to KEI Industries. That's going to be my first question. Second one, will the 20% plus kind of ROCE number continue? Why? One, with competition coming in, could this be the new paints? Second, a fundraise. They've done a 2,000 crore rupee equity raise, and does that in some form or shape hamper the return ratios is what I'd want to understand better for FY26 and FY27 especially, because FY28 onwards probably growth will take care of that, but at least for the near term. Now in terms of downside risk, is there a downside risk to export market? There's plenty happening on the geopolitical side, and therefore that could be one risk. Capex plan, whether that one is on track. It's a large capex that they are planning, and therefore we'll want to understand that. How quickly do capacities come on stream? Is all of that on track? Sadanand phase 1, that project should at least get done by H2 of FY26. So want to understand whether that is on track. Margins on export versus domestic, this I'd want to know, because they're shifting base towards exports in a big fashion. Now their export is around 13% of the mix. That will likely continue to inch higher. The aspiration is to get to 20% in the next couple of years. If export is going to do well, and if margins are better there, you could well see a margin upside from here. But there's a margin downside. Raw material prices is a key risk. For the moment, they've been able to hedge raw material prices, pass it through to the customer, but is that at all a risk going forward? Cash flow in FY25 was a concern. They reduced the number of or the amount of payables they had because of the large cash balances that they held. Well, is that likely to reverse at some point is what I would want to understand. Will they go back to increasing payables, and therefore will there be an unwind at some point of that large cash flow that went out from operations in FY25? So some of these I'd want to know better. But let's quickly understand the company, and Puneet will join me shortly with regard to this. It was founded in 1968. It's been public since 1992. It's the second largest cables and wires company in India. It commands around a 9% market share in India. They intend to rigorously defend that market share is part of the commentary that we've got. Supplies to infra, power, industry, real estate, exports and retail. So across the board, it has a pan-India presence and it has a growing global presence with 60 plus countries is what it is present in. Let's look at some of the products, and we'll quickly have that in one slide maybe. Okay, so let's look at revenue distribution first. Okay, 94% is from cables and wires. EPC has come down sharply to 4% now, and stainless steel wires is 2%. EPC at one point was late teens. In fact, not too long ago, maybe FY18 or FY19 was a large chunk of the top line, maybe 18 to 20%. Now it's just down to 4%. They are granularizing their top line more, and that granularity is giving them margin tailwind. So all of that has started to play out. Let's look at the revenue mix as well, and within that mix, retail is now 52, institutional is 48. That allows for better margin upside because retail will always give you better margins, the B2C. Now let's look at products, and let's pull up that slide, and that will give you a full picture of all the products they do, largely into almost every product within the cables and wires space. So it has a large plethora of products. Wherever they don't have an R&D or they don't have a specialization, they have tie-ups. And that kind of helps, especially in the EHV cables, where some of the higher kilovoltage cables is where they have a tie-up. So well, that too is likely to drive numbers. When I'm looking at customers, retail customers through distributors is what they tap into. They currently have around 2,100 dealers, and they do both international as well as domestic. I did speak about the mix. Around 13% is what the international mix number currently stands at. In terms of value chain, they do manufacturing, warehousing, B2B and B2C, and thereafter also exports, if at all. Now, they manufacture through 6 plants. One is in Rajasthan, Silvassa, Sanand. We spoke about the Sanand plant and the capex that it's going through. It sells via dealers, which is B2C. They also do direct to industries and governments, which is B2B. They do exports. 52% is retail, 35% is institutional, and 13% currently sits in that exports basket. Raw material is largely commodity driven, and it follows pass-through pricing, and therefore you'll see very, very limited impact on margins is what the management has guided for very, very comfortably. But that's the holistic picture with regard to what KEI Industries does. Let's get into the metrics now, and let's start off with the metrics themselves: income statement, balance sheet, cash flow, return ratios, shareholding, street cred, street coverage, and valuations. We'll cover all of those 8. And as always, Puneet joining me for that analysis. Puneet, let's start with the income statement.
Well, definitely, Harsh. And the key aspect is the strong growth in revenue that we've seen for the KEI Industries over the last 2 to 3 years. So it's definitely grown steadily, and post the slight dip in which we've seen post the pandemic, it has recovered very well. Like the other cables and wire companies, we've seen a 19% CAGR in terms of revenue. EBITDA has grown in line with a similar percentage. It's very difficult to do that because it's a very highly commoditized industry. Copper prices are very volatile, and we saw that impact post the pandemic as well. But company has been able to maintain that margins. Slight blip which we saw in FY25, and is expected to be around 11 to 12% in this year as well as the coming year as well. So that'll be something to watch out for. But that's driven by the profitability growth of 23%. So we've given this a thumbs up. No two ways about it. It's been a strong product profile over the last 3 years, and that's reflected in the growth in revenue as well as profits as well.
Okay, so that's with regard to the income statement. You can see the journey. Do we have maybe a 3-year or 5-year chart with regard to how the income statement, margins, etc. have moved? Let's pull that one up as well. That'll give our viewers better perspective on how the top line, the margins, as well as the PAT has moved. Okay, let's quickly move on to the balance sheet. And in that balance sheet, if you see the way in which your equity has moved, it's inched higher because of the 2,000 crore fundraise that happened in November of 2024. The other equity number also rising significantly as a result of, one, the strong profitability that we saw in FY25, but also as a result of that fundraise. So both of those reflecting on the book value currently, which is sitting at sub 6,000 crore. It's a 38,000 crore market cap company. Just something to keep in mind. The borrowing number is at around 178 crore, so fairly healthy balance sheet. They've repaid some part of their borrowing, post the fundraise, and the cash bank balance currently sits just below 2,000 crore at the end of FY25. Of course, the Q1 numbers still need to get adjusted in the balance sheet. We don't get that disclosure. So broadly, it's a thumbs up. No question, no worries with regard to how the balance sheet looks at the end of FY25. Cash flow, Puneet.
Well, cash flow is very interesting because, we've seen a slight impact in FY25 numbers. And that's largely because of what's happened, in terms of operating cash flow. It's visible that FY25 was only negative 32 crores, while over the last couple of years, it's been above 500 crores of cash generation from operations. Now that was impacted due to working capital changes. Inventory has moved up to over 390 crores, and that's largely because of the volatile copper prices that we've seen the last year. So the company did go out to have higher inventory of copper. It's similar to what they did in 2022 as well. At that time as well, the copper price, the inventory was over 300 crores for the company. Because of that, there's been a delay in receivables as well as payables as well. So we've seen that impact happening on the company's cash flow to EBITDA ratio as well. But largely this should be solved into this year, because we've seen that within copper prices it is still at a high, but the companies are managing their way into maintaining the inventory of copper in this particular quarter. So it will be something that we can quiz the management on as well. But largely we've given this a neutral rating because of what's happened in FY25. FY22 to 24, this was largely stable in the metrics that you can see on your screen. But hence, the cash flow to EBITDA conversion was delayed because of working capital impact.
Okay, so that's with regard to the cash flow. We've given that a neutral. We want to see how quickly that unwinds. We spoke about that as well. Let me talk about return ratios. They've been consistently above the 20% mark. No concern there. Not going to discuss this too much. Going to give this a thumbs up and quickly move on to shareholding, Puneet.
Well, shareholding as well, largely been stable. We've seen the promoters maintain the 35% stake over the last couple of years as well. So we've seen a slight increase, and you can see that in the from what happened with domestic investors as well. In FY24, we did see some selling, and that could be one of the key reasons why we've seen an increase of that to 20%. But even from those levels, we've gone back to 26% of ownership from domestic individual investors. This includes all mutual funds amongst and HNI investors as well. So we're seeing that kind of positive impact. For the public, there's been some kind of selling, but that's largely because the stock has also done so well in the last 5 years. But overall, we've given this again a thumbs up, stable ownership by the management, maintaining that kind of view in terms of the strength towards the business, and hence giving this a thumbs up as well.
Yeah, we track number of shareholders as well. That's reflecting on your screen. See how the number of shareholders have inched higher. Let's look at street cred now. 1 month, 6 month, year to date, 1 year. You look at the performance, it's been okay. It's been a flattish kind of a move over the last year or so, plus minus 12%. But you look at the 5-year picture, and that's where you will really see the kicker. It's been a 11 bagger over the last 5 years. So some real solid tailwind, and that performance is reflecting on the income statement very, very frankly. So it's not a surprise to see the kind of compounding that we've seen. It's been one, a PE multiple re-rating that's happened, and you've seen very, very strong tailwind even in terms of growth. So both of those are playing out as we speak. But talking about valuations, Puneet.
And, in terms of valuations now, it's important to look at the relative valuation of the other peers as well, because while KEI Industries trading at 35 times price to earnings for FY27 would seem expensive, when you look at the other players as well, they are valued very well as well. For someone like a Polycab, it is the market leader, has 26% market share, but maintaining that kind of valuation. And we've seen over the last 2 to 3 years, for KEI Industries, it has now become, in terms of valuation, on par with someone like a Polycab. It was always the second largest player, but we've seen that kind of valuation in terms of KEI to be maintained at 35x. Let's also look at the other players like Havels as well as, in terms of Finolex. And for Finolex, we see that valuation discount largely because of the company's slow growth. So the market not rewarding as effectively as someone like a Polycab and KEI. And for Havels, we've given this a comparison. But for Havels, there's also the consumer discretionary and the AC business that takes a higher valuation, and hence at 48 times. The wires and the cables is one part of that business now. So for Polycab as well as KEI, we've seen that inch up. For RR Cables, it was a stock which was trading around 24 to 25 times before the last couple of quarters, seen that inch up as well. So a high growth industry with industry leaders and players participating very well. So we've still given this neutral only because of the higher number, but the growth aspirations of the company to have till FY30 is what they mentioned as well, is very, very high. So we have to look at that aspect with the growth coming in. The market is hence okay to give us a slight premium to someone like a KEI Industries.
Absolutely. So that's the take with regard to valuations. And quickly on to what analysts are saying about this one. 18 buy calls, 4 holds, no sells, 1.5% upside. So the upside in that sense seems capped, which is why we've given this a neutral. Chairman, Managing Director, KEI Industries, to talk to us about, one, the quarter gone by, but overall, the big picture as well. Mr. Gupta, you set this up from scratch. You joined this place in 1979. What is your take with regard to incoming competition? You have a fantastic grip on the business as well as on the industry. Give us your honest take.
Good morning.
Good morning, sir.
I think that we have established ourselves very strongly in this business. We know the business, how it is to be run in all fronts. So I agree that some big players are have announced their entry in this space, but the market is substantially growing. Economy is growing, and I think there will be a space for one or two large players to come in. Will not much make difference to us. We know how to diversify our product portfolio and diversify our markets and market geographies. So, even if we have to face competition in domestically a little bit, we will cover it up from other geographies for the growth purposes. But I'm sure that we will be able to maintain our market share and even grow our market share domestically as well.
Mr. Gupta, a very good morning to you. Thanks so much for joining in. It's Puneet this side. I just wanted to take a couple of questions on the new Sanand facility that's coming up. And, you've given a very detailed outlook in the past as well. But on phase 1 specifically, you will have, the low tension as well as the high tension cables coming in. In that context, what is that expected to do for KEI in the medium term? Because you've given a strong guidance till FY30 for about 20% revenue growth. So essentially, with the phase 1 coming in, how do you expect that to benefit KEI? Because there is some competition in this particular segments as well. So how would you be catering to that?
See, our phase 1 of this project is likely to be operational by September 25, and full project will be operational. Phase 2 will be operational by end of first quarter of FY27. But about the competition, I think the demand of our products is quite significant. We are actually, struggling to meet the orders timelines because of the capacity constraints. And a lot of international customers are waiting for us to start catering to them. We have a little bit slow down on our export customers because I don't want to lose our domestic market as well. So as soon as our capacities come up, we will full-fledged go for the grabbing the market in domestically as well as international.
So what is the...
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसे हल्का सा भी खौफ नहीं है.
मैडम एक बार को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा.
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसा हल्का सा भी खौफ नहीं है.
मैडम एक बार को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio. Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. That show should give you a sense of what we're talking about. Everything related to your money matters. And today I'd like to speak about investing in global equities. Now, if you've been following the show, or if you're reasonably familiar with the landscape here in India, then you know that it's getting harder and harder for Indian investors to deploy money overseas. And that's because the Reserve Bank of India, and by extension the Securities and Exchange Board of India, has not increased the overall threshold for Indian mutual funds to invest in global equity. But there are a few options that are opening up. Among them, the DSP Global Equity Fund, which is going to be operating technically not in Indian shores, but in Gift City. And that, if you can think about it, like an island that is operating in India, that is separate from India, but actually allows you access to the global markets, then that's how you should think about it. Join me to talk about what this fund is all about, why it's different from everything out there, and whether it's an opportunity for you to consider. I'm joined by Vijay Mantri, who is an investment expert, as you know. Vijay, thanks as always for taking the time.
My pleasure.
So first, before we get into DSP and this new offering that it has, I described the Gift City in a certain way. I described it as an island that gives you access to the globe. Is that the right way to explain it?
I think this is fantastic. This is the crux of forget about the legality, but this is what it is. It is a window through which you invest in international market. It is a window through which international investor can also come in. So it's like a global financial center. It is at the initial stage, but I think over a period of time, the intent is to make it as competitive as Singapore or Dubai.
So, and to complete this point, from the lens of an Indian investor, and here I'm only talking about a retail investor looking to invest abroad, if they're going through GIFT, then effectively they would have to go through the liberalized remittance scheme route, which allows you to put $250,000 in assets abroad, take that much money out every year, correct?
That's right. Per PAN card, you can remit up to 250,000 USD. That translate into, at current exchange rate, around 2 crore rupees. Approximately 2 crore is the number per PAN card.
And that's the way that you invest through GIFT.
So this is the way you will invest in groups. So if I'm an Indian investor and I'm looking at international exposure, the easiest route earlier available to me was invest through fund of fund, which mutual fund offer.
Yes.
But there's $7 billion limit, which already we busted, and RBI is not allowing incremental money. And that is the reason you see all these funds have a difference between NAV and the price. Okay. Now, the GIFT City routes was opened up. So you could invest through GIFT City, but it is only through LRS route. Now, the challenges with LRS route and GIFT City is that the minimum investing amount is 150,000 USD. So that is around, the starting amount is 1 crore only. So it is away from many investors. And second problem is that in LRS, suppose your remittance is more than 10 lakh rupees, then there's a tax collection at source, which is 20%. Definitely you can take that claim in your income tax against advance tax and in your other things, but at least your cash flow get blocked for time.
20%, that's a lot.
Beyond 10 lakh rupees.
Yeah.
So if you are investing in GIFT City fund, normal GIFT City fund, then suppose your investing amount is 100,000 USD, that is 86 lakh rupees. So beyond 10 lakh rupees, 20% you have to put. Okay.
And that's earning you nothing.
That's earning you nothing, but see, you have advanced tax, you can use
You can set it off.
You set it off.
You can set it off. If you're operating at that level, perhaps you have that kind of stuff that you can do. But having said that, that brings us to this conversation, which is the DSP Global Equity Fund. And it is aimed at your retail investor because the ticket size is much lower. The minimum amount that you have to put in is $5,000. Is this the game changer that people are talking about?
I think this is a game changer because 5,000 USD means 4,30,000 to 4,50,000, depend on the exchange rate on that particular day. So it has come within the reach of middle classes. And suppose you have 4 members in the family, effectively you can do 20 to 25 lakh rupees annual, and you can go up to 10 lakh rupees without incurring TCS. So that way it is a game changer. And I also, hearing that the amount is going to go down further and further.
Okay.
Starting 5,000, perhaps they will make it 500 USD. So it comes within the reach of a normal investor. And the great advantage of investing through LRS, there are many competing platforms available through which you can invest in international, invest through LRS. You can go and invest in fund in USA, you can go on asset or direct stocks. But the challenges is that these platforms are unregulated. Many of these platforms are unregulated, point number one. And we have witnessed that some of these platforms have closed down in between, so investors are left to grapple with it.
So what you're suggesting is that, of course, through the LRS, what a lot of people are saying is that, okay, the domestic mutual fund industry is not able to provide you with the option available. So what a lot of people that are seeking to invest in global equity, and particularly the US or in China or elsewhere, what they're doing is they're setting up accounts with global brokers or global providers or platforms. And they're facilitating your transactions.
Yeah, so one is that these platforms that are not regulated, tightly regulated entity. Second, which is very important thing, is inheritance tax. Suppose you invest through these platforms and invest directly in international market, then if beyond a certain limit, 60,000 USD, I believe, if something happens to you and the money has to be inherited to your legal heir, at that time, up to 40% can go in form of inheritance tax.
Wow.
Many people who invested internationally was not aware about these.
Right.
But through this DSP fund, through GIFT City fund, if you invest in through LRS route, then there's no inheritance tax applicable.
Sure.
So that way it is much better.
There are several questions that emerge about this scheme, okay? And the reason, viewers, why we're focusing on this scheme in particular is because it is the first of its kind. As Vijay just pointed out, the others have a much higher ceiling or threshold for you to get past, for you to invest in. So the first and foremost question is, it was launched earlier this month and it has a significantly large new fund offer period, as I understand it, right? So how is it going to work? They're in the process of collecting money right now. When will they operationalize?
So they will start collecting money and then they will start investing immediately. It may just a gap of 10, 15, 20 days. So they will start investing. And you need to go to your bank and convert your INR into US dollar.
Sure.
So that responsibility today is with actual investor.
Sure.
Earlier, what used to happen, you give money in INR to the fund and the fund will convert into USD and then transfer. Today, you need to go and negotiate exchange rate with the banker.
And you need an account in Gift City as well.
No, you don't need an account in Gift City. You go to your normal bank.
Okay.
And banks are authorized dealer. You fill a form and you get the INR transfer. But before that, the better thing to do is to connect with your mutual fund distributor, your investment advisor, create a zero balance portfolio in Gift City.
Sure.
Using DSP Mutual Funds Service Center. Open that. Once that zero folio get created, then you transfer the money. But in this, you definitely need to take a help of your advisor.
Sure. Okay. And so therefore, the onus of transferring that dollar is on you, that conversion rate is on you.
That is like any LRS product.
Got it. So now this is done. Let's assume that you've done that and you've put that minimum amount. You've said that they will deploy it over a period of time. It'll start more or less now, right?
Yeah.
But how does that work and what are the contours of that fund? It's actively managed?
So the brilliant part is that it is not an index fund.
Sure.
And it is not a country specific fund. So it is an index agnostic, it is a geography agnostic, it is sector agnostic. They very clearly define how they're going to look at investing, and that's why I found it very interesting, because most of the global funds are looking at investing in high-tech company, innovation. This fund is looking at a little differently. It is looking at the company in which you and me are using the product of these companies like Puma or like Lilly or like Airbnb or these kind of organizations. So large, well-established player. So instead of big innovation, iteration is a one thing. Longevity over growth and resilience is the kind of thing they're looking at. So they're very well defined that they are looking at 5-6 big market, US, Canada, Europe,
South Korea,
Japan, South Korea, a little bit in China. And they are saying that they will look at investing in a company with minimum $30 billion market cap. That is number one. Number two, 5 to 7% revenue growth, earning growth. 2 to 4% shareholders yield, which is in the form of dividend and buyback. And if you see today in international market, there are some fantastic stocks available at very high dividend yield. For instance, look at Altria, is one of the tobacco manufacturing company in USA, available at less than 10 P multiple and close to 7%, but close to 7% dividend yield in USD.
But this fund is not going to invest in banks or tobacco. That's what I read.
No, I don't know about that. So they may look at. So you have a big gaming company part of this portfolio. So one is that in my opinion, you're going to get a genuine diversification. Today, suppose if you ask anybody international investing, you would like to own NVIDIA, you would like to own Amazon, you would like to own this and that.
But there are so many you don't know about.
Exactly. So when you look at Amazon, and when you look at Louis Vuitton, or when you look at Brookfield Asset Manager, now for one Amazon, you need to search 100 companies to find one Amazon which made it big. But when you go to these well-established companies, even 50% strike rate makes you a good investor. So people need to keep that thing in mind.
And 30 to 50 stocks is what they will
30
have.
to 50 stock, they are looking at investing. Sizing is 3 to 5% in individual stocks. Buying companies at 30 to 40% discount to a fair value, and in the global market beyond this big tech company it is available. And if you look at very interestingly in US market you have top 5 tech company, 35% of S&P 500. Top 5 companies are, if you look at tech, top 5 company in USA, they are 5 times bigger than Russell 2000. It's an incredible number. And if you look at return, these S&P 500 is available at 30 P multiple. If you look at other indices, they're available at 18 P multiple. And if you look at return in India, small cap has delivered fabulous return compared to Nifty but in US it is absolutely the other way around. The Russell 2000 has underperformed by 7% in last 10 years. So I believe there's opportunities beyond the big tech name, in my opinion.
Yeah, the size is something that you just can't wrap your head around. NVIDIA market capitalization would capture the market capitalization of a large part of our markets, right? All of it. NVIDIA
is 65% more. You put the entire Russell 2000, NVIDIA is 165% of that alone. Now the problem with these companies that if one quarter disappointing result,
then it's a significant wealth erosion.
Challenges.
Okay, so then a few more questions arise. Regulatorily, domestic mutual funds are governed by the Securities and Exchange Board of India. There are contours that are defined. For example, a flexi cap fund is open landscape, or a multi-cap fund is 25, 25, 25 in each large, mid and small. How does this work? Who's regulating it?
It is the GIFT City regulator, IFSCI, so International Financial Service Cap.
And how is that going to work?
So it is, they have taken by and large, exactly not regulated by SEBI, but it is, since it is offered by DSP mutual funds, so they will follow the best practices of Indian regulation. So they are not going to take advantage since it's listed in GIFT City, we can't do anything. Absolutely not at all. So by and large, it will be managed as per SEBI regulation. No, not strictly, but in the spirit they're going to follow as far as diversification is concerned, and all these things they'll take into consideration. And they are offering two share class, one direct and one normal. And expenses are 1.75% for a normal.
1.5, I thought direct.
25 basis, 1.5 is direct, but 175 is normal. If you offer,
and I thought it was 2.5 for
no, regular. That has come down to 175. So they're not offering it 2.5%. So again, it is very competitive as far as pricing is concerned. And third is that it is governed by the GIFT City regulation. So it is a regulated product, is not an unregulated product.
1.5 and 1.75 to invest in global equities at this juncture with our current context is not too expensive.
It's very good.
Yeah,
and you get the professional fund management team, you get a brand like DSP managing your money, an entity which is always err on the side of caution.
Do you think that more mutual fund houses will contemplate this?
Yes, I think they should, and they should come out with a differentiated product. Then it makes sense, because if you're using GIFT City to feed into index fund, you can't charge 1.5%.
Okay.
And there are fantastic opportunities available in international market if you go beyond indices.
Now, so that's about the DSP option. I want to also talk about the investing in international equities as a concept. A lot of people tend to want to do this, and now through DSP as well, to manage currency risk. Directionally, over the last 25 years, and even before that, you've seen the decline of the Indian rupee, the depreciation of the Indian rupee. It's anywhere between 2 and 3% on an annual basis. Is that one of the best reasons to invest in international assets?
Interestingly, yes. And which currency will do which way, we don't know.
Yeah.
So today we are talking about Indian INR is holding strong against USD, but not against Euro. Euro has appreciated much more. So there's definitely currency is one part. So second is that Indians send 11 lakh students every year, and that amount is pretty big. So if you look at education, inflation has been 4%, currency depreciation actually has been 3 to 4%. So if you want to send your kids abroad for higher education, 8% is a minimum threshold you should look at. This fund, in my opinion, look at 10 to 12% kind of dollar return in 3 to 5 year period. So if you want to take international exposure, if you want to protect your money against the international currency as well as education costs, then this is one of the product you could look at examining.
Okay, couple more questions. 4 lakh plus rupees, not a small amount. Of course, if somebody's been investing for some time, they will have a sizable corpus. But if you're starting out, what is the kind of exposure that you should be willing to take as a part of your entire portfolio?
So in my opinion, one should look at investing at least 10% into international market, because we consume the product of these companies.
Sure.
So today, if you look at consumption pattern, we consume, India does consume, we live in a global village. So I think 10% is a good idea. And 4,30,000 is not a big amount, because look at iPhone is 1,50,000, and how many people are buying iPhone?
Yeah, well, that's a strong argument to make.
Yes.
But having said that, overexposure is something to also avoid. So 10% is what you're saying is an ideal. How much is too much?
I think 10%, in my opinion,
is correct.
You can, in this market condition, you can take a 20% as well, because Indian markets are very funny. They don't look at Nifty P multiple, which is 2022.
Yeah.
But if you look at average P multiple of 750 companies in India, the average P multiple is 40.
Yes.
At 2026 earning.
Yeah.
So we are not cheap.
No, you're seeing practically every day, Vijay, the margin for error for a company posting results is just wafer thin. If you miss even on one parameter, you're going to get trounced in the market, and that is evident. So anyway, the point is well made. Look for diversification. Hopefully more mutual fund houses will come out and give this option, and hopefully that ticket size also comes down further.
Exactly. So and you also need to keep in mind that what is cheap today? Debt is offering very low, because after the interest rate has come down, gold and silvers are at hitting the high every day because of dollar. Real estates are not cheap. Equity markets are not cheap. Indian equity markets are not cheap. I don't think Indian equity markets are going to fall any which way big time, because it is today become frontline on assets, and we have huge inflow coming from various sources. So I don't think we see big correction, but from here onward, at least for 2-3 years, to make double-digit return will be a toss in the air.
Yeah, all right. On that note, Vijay, thanks so much as always for taking the time.
My pleasure.
It's all about diversification on today's show. We spoke about investing in international equities, and now I'd like to talk about investing in gold and silver. I'm adding silver into that conversation as well. Navneet Damani, Group Senior Vice President and Head of Commodities Research at Motilal Oswal Financial Services, joining me now. Navneet, thanks so much for taking the time.